And it should be good.
Okay. Good morning. I'll call this public hearing of the Banking Committee to order Tuesday, February 9th. Looking forward to a good discussion this morning on several bills that we have for review on our agenda. Before we get started, like to just mention sort of the general rules as we're all learning process of having these hearings by Zoom. We remind everyone, first of all, to remain muted until it is your time to speak, and then remember to remute yourself when done speaking. We have a raise hand function within Zoom that members of the committee can use to ask a question. And so please try to use that. We can't always see everyone on the screen in real time, so it's helpful to do that, but we'll do our best to accommodate that. Use of emoticons in Zoom is not allowed. Please don't use the Zoom chat as well, either public or private. The chat records are saved by default and would be part of the public record for the meeting. For the speakers who are watching at this point, we will have a 3-minute rule, as is the rule for all committees. So each speaker will have 3 minutes. We will do our best to signify when the 3 minutes has expired, and then we ask that everyone at that point wrap up quickly. Of course, the committee may have questions for those who are testifying. So any other points or that you wish to discuss with the committee can be done in that format as well. But we will, to be fair to everyone, adhere to that 3-minute rule. So with that, I think we're ready to get underway. I don't know if my co-chair or has any comments before we get started.
I'll just say very briefly the same thing I said in our committee meeting just prior to this hearing, which is that whether we have 9 people or 90 people or even more testifying, we welcome everybody. We want everyone's voice to be heard, and we're so delighted that you are participating in this public hearing. I'm delighted to see every single person here, and particularly delighted to see my colleague, Senator Abrams, who will be speaking first.
Ranking members, anything to add?
Good morning, chairs, and good morning to the public out there that are viewing the public hearing. This is always an interesting time when the people come out and they speak on bills, speak on proposed legislation, and I too am looking forward to hearing what they have to say. Thank you.
Thank you, Mr. Chair, Madam Chair. I share all of your sentiments as well. Let's get underway and let the voices be heard.
Okay, thank you. Thank you. So with that, we will begin calling on those who have signed up to testify. And first on our list this morning is Senator Mary Abrams. Good morning, Senator.
Good morning, everyone. Senator Kasser, Representative Doucette, and the fine members of the Banking Committee. It's a pleasure to be with you this morning, and to be the first one to speak is an honor. Thank you so much. I'm here to talk to you today about SB 428, which is an act concerning the assessment of interest with respect to credit cards. I think that when we have statutes, we try to make them as clear as possible so they're implemented in the fairest way. And a constituent brought this to my attention, so it's why I proposed this. So it's to amend the Connecticut General Statute, Section 37-1, which currently states that judgments for monies loaned are subject to mandatory award of post-judgment interest, which I believe currently is 8%. The question is, are credit card charges for goods and services considered monies loaned? Of course, any cash advances on a credit card account would be considered monies loaned. And because there is a gray area here, there's some inconsistencies in how it's applied. And so depending on who might hear your case, it might be applied differently. So I'm proposing that the resolution is to change that language so that it would state, this section shall apply to cash advances on credit card accounts, but shall not apply to monies due for charges for goods and services made on such accounts. I believe this change would provide more clarity and also protect consumers from any arbitrarily imposed post-judgment interest awards. So thank you very much for giving me your time.
Thank you, Senator Abrams. So I'm curious if your constituents provided any examples of how this could be applied and the issue that this could potentially resolve specifically.
Well, the issue was, in some cases, well, I guess this person became aware that in one case, the charges for goods and services was used as part of the post-judgment award. And then they knew of someone else who, in that same situation, those were not applied. And so in looking at it, it's, it says that credit cards, that there's interest on monies loaned. So it's whether or not you consider credit card charges for goods and services as monies loaned or not. And so depending on who's giving the judgment, they may decide that it does or may decide that it doesn't. So I just felt that this language would clarify that for me, I fell on the side of, being more friendly to consumers and not considering that. I suppose you could do it the other way as well, but I think clarity is the most important thing. And obviously I'm falling on the side of clarity, which gives a little protection to the consumer, but you could certainly go the other way.
Okay. And do you happen to know if how other states treat this provision in their usury laws?
I do not know that.
Okay.
Yeah.
Like most of the legislation that we consider, there are implications of both federal and state law and the laws of other states as they apply to the institutions that are being regulated. So this is interesting. It's our state usury statute, which has pretty broad implications, but at the same time, we have to consider who we're attempting to reach and regulate, which sometimes is a matter of federal preemption. And particularly with credit cards, I know there's a whole host of issues related to conflict of laws and preemption. But no, I agree with you with the premise that it would be something good for consumers. So I thank you for bringing it forward.
Thank you. And I totally understand that you have such a broader picture to look at and have a much greater understanding than I do of this. And so I just, like I said, first and foremost, I just think clarity would be the best thing. If it fits better in a different way, but just being clear so that people are all judged equally when they go up for these.
Good. Any other questions for Senator Abrams? Anyone with a hand raised? Rep. Telnicki, is your hand raised?
Yes, it is.
Okay.
Very quick question, and I don't know whether you'll have an answer for this or not. Do you know of any case law pertaining to this where a consumer actually challenged the situation that you described?
I do not, or that someone brought a challenge because they knew that it was being
Right.
implemented differently? I do not. That's a good question.
Is that, I raised that from the perspective that perhaps the issue's already been settled and we just don't know it.
Yeah.
And it's one of those questions that an attorney would have to research, I would think. One of our staff attorneys to know whether or not it already has been adjudicated and there is law, case law.
I don't believe there's case law to that extent where people are using it to go back and look and see how this should be judged. But I could certainly look into that.
Again, thank you for
Good
bringing
point.
bringing that bill forward. And I can truly appreciate the fact that it would be good to know exactly where the rules of the road are. Thank you.
Exactly. It's what we try to do.
Thanks, Rep. Delnicki. So anyone else? I don't see any other hands right now. Going
I'd just like
once,
to
going
make
twice.
a quick comment and just
Sure.
thank Senator Abrams. We can look into whether there is precedent or, what the legal landscape is, but I just thank you for giving us an opportunity to clarify language, because if our laws should be one thing, they should be predictable and they should be applied evenly across everybody. So this is maybe one small example, but it's still an important example of why we need predictability and clarity. So thank you.
Thank you. I think it's one of the great things about how we all have constituents that bring things to our attention that we wouldn't otherwise know about, so we can do a better job, because I know that's what we want to do. Thanks, Senator Kasser.
Absolutely. Okay, anyone else? If not, Senator Abrams, I thank you for your time this morning.
Thank you very much for your time.
Okay. Take care. So next on our list, we have Representative David Ritigliano, who will be followed by Michael Harris. Is Rep. Ritigliano with us this morning?
Good morning.
There he is.
That took a
How are you,
second
Representative?
to figure it out. It is my first time testifying, so I apologize.
It's my first time chairing a hearing as well, Zoom. So
yeah. Good morning, Senator Kasser, Representative Doucette, Ranking Members Delnicki and Berthel. I am here today again on a bill, HB 5214. I submitted testimony. I hope you have it in front of you. Your committee was kind enough to take this up a couple of years ago. We had a nice discussion about it. I don't know, in the course of things that it may have gotten lost in the sauce. But so instead of reading my testimony, I'll just tell you the situation, which I believe is predatory and not helpful to consumers. And that is the partial application of a mortgage payment by a bank or a mortgage servicer. So it happened to me, and then I called around and talked to other constituents, and this happens too. So I made my normal monthly mortgage payment, and I didn't realize, or I didn't know that my escrow account or my local property taxes had gone up by $30, $40. So I had made my normal mortgage payment, but I didn't include the additional $35 that was required monthly to fulfill my commitment to my escrow account. So a month went by, and I got a notice with my next bill from my mortgage company that I owed them 2 payments. And then I was in danger of a late fee, and I was going to report it. They were going to report it to my credit card my credit reporting agency. I'm a diligent bill payer. I have a phenomenal credit score. It took me by surprise. So I called up the bank. I said, I sent you the payment. They said, well, you were off by $35. I says, well, you had enough to cover the interest and the principal on the mortgage. Why didn't you apply the payment and then ask me for the extra 35? The tax payment isn't even due for another 2.5 months. And they said that I did not meet my contractual obligation for my payment, and they weren't applying anything. Personally, I thought this was outrageous. I feel it's predatory. And if there's folks out there that maybe don't pay attention as well as I do, or just going about their normal life and they're making their mortgage payment, I didn't think that this should be allowed. If they had enough to apply the mortgage payment and the principal payment, they should do that, and then we could all talk about the escrow later. So that is a basic summary of my testimony. You should have it in front of you. I'll be happy to take any questions. And on another note, a little bit of a sad note. This was the last conversation that I had with Representative Santiago, to be perfectly honest. You guys had just raised a bill, and he was so kind to come out in the lobby of the LOB and let me know, and we had a pleasant talk. And it is a sad reminder of who we've lost just a few years ago. So I didn't mean to bring everybody down, but I was reflecting on that when I was rewriting my testimony. So thank you very much.
Thank you, Representative. Yeah, I remember that too. And I remember your bill, and I remember discussing it with him. Yeah, we're reminded of him almost every day when we're on this committee, especially now as we see a lot of bills coming back. But I appreciate you bringing it back. And again, in his memory, I want to see through some of the work that we started back 2 years ago. You may recall from our discussions back then, and this applies, and I just said this to Senator Abrams as well. So this is sort of a constant theme in our committee, that a lot of our issues tend to be preempted or have conflicts with federal law. With the mortgage market, especially, and we do a lot of things to try to regulate activities and deal with problems as they affect consumers in the mortgage industry. We run into the issue that approximately 70% of the mortgages in the state of Connecticut are federally regulated entities, or the GSEs, Fannie, Freddie, FHA. What we can do, any bill that we move forward in most cases applies only to state regulated institutions, which, then creates a question of, well, you have a playing field that's not level. There are ways that we can enact legislation that affects all lending institutions, but in terms of regulating, as far as the banking statutes go, they often can only apply to state regulated institutions. So this is one that I agree with you, and I think we've heard this from people, and like you said, experienced it even ourselves, that is one that I think would help and be fair to consumers, and so I'm definitely interested in looking at it. The question is just how that preemption issue can potentially be resolved. Any thoughts on that, or any discussions that you had a few years ago?
I appreciate the complexities of the issue, and then I would defer to your expertise in the banking committee. But just as a general sense, I think that, to me, this just feels like a predatory practice, and that we in Connecticut should be able to protect our mortgage holders and against what I deem as sort of an unnecessary thing that the banks may be doing to some folks. And I'm curious to know, and I've asked the banks, they've come and talked to me, and they're like, well, it is, sometimes people don't pay their whole bill. And I'm like, well, if they don't make their mortgage and interest payment, then you have every right to take all legal recourse. I says, but this is really a simple escrow payment. I don't even know if that's even part of your contract. Many people don't even decide to put their insurance and tax payment within their mortgage payment. So I didn't really understand their answer. It wasn't an acceptable answer to my point. I would think that the contractually obligated payment would be the principal and the interest, not all the other stuff. So it rang a little hollow, and I felt that maybe we could do something about it, because it really didn't have to do with the primary reason you have a mortgage, which is your principal and interest payment.
Yeah. The escrow payment is buried in the mortgage document. And I only know that as a real estate attorney every day, sitting with people going through those documents. But what is interesting about the question as posed is that the escrow payment itself is basically just to catch up with, like you said, when the taxes go up. So the lender is always paying those taxes anyway, because they have a
Right.
interest in making sure the taxes stay current. But the escrow payment is just a matter of catching up to any increases in the taxes, which often happens months and sometimes even years later. So your point's a good one. That
Also, if you think about it, I always go back to, who do you actually owe the money to? if you're short on your tax payment, your town is coming to talk to you, right? Not the bank. If you're short on your mortgage or interest payment, then you have to deal with the bank. So it felt to me like the bank was sort of doing the bidding of the town, when in reality, if you don't make your tax payment, you're going to have to deal with your local municipality, not the bank.
That's right. Well, they pay it up front because the municipal taxes are a superior lien potentially to their mortgage. So if they fall behind the taxes, the town has priority over their mortgage. So that's why they have an interest in paying it quickly. But to your point, you're just they're trying to catch you up. So I agree with you. There should be some more of a grace period notice opportunity there before you fall too far behind.
At least apply your principal and interest payment so that you don't, run the foul of possible foreclosure, of credit hit, or even the increase in interest because they didn't apply the payment.
Right. So yeah, thank you again for bringing it forward. Any other questions for Representative Ritigliano this morning? Senator Berthel, I see your hand raised.
Thank you, Mr. Chair. Representative, always good to see you. Thank you for coming before the committee this morning. I remember when I was on this committee a couple of years ago, obviously when you brought this forward, and I think that just listening to the dialogue with Representative Doucette is a real estate attorney and handles this stuff on a daily basis. So I think that it's good that we can, I think, agree to explore the legal landscape, just as Senator Castor spoke to about the testimony from Senator Abrams just before you regarding that matter. But I agree.
By the way, I completely agree with the senator. By the way, I mean,
yeah, I think there's opportunities for the Banks Committee to look at some of this and just ensure that we're staying within the legal framework of contracts and what have you, and proper application, and not that our lenders aren't doing great jobs and doing great things for people, and home ownership is a wonderful thing. But I think you raise a valid concern. I can't say that I'm not sure that I haven't been victim to that myself, where you get a statement from your lender saying that your taxes have gone up or your property insurance has gone up, and there's a $30 a month additional fee or additional amount that you owe. And I pay my mortgage automatically, so it just, if you don't adjust that automatic payment, you could end up in exactly that situation. So thank you again for bringing this in front of the committee a second time, and I hope that we can find some way to respond accordingly and do something with it. So thanks again.
Thank you, Senator.
Rep. Delnicki.
Thank you, Mr. Chair. And thank you, Representative Ritigliano, for bringing this forward. Partially the question that I had, I think, was kind of asked, but not quite. Did you receive any notification that your mortgage payment was going to be higher based on the taxes changing?
I won't say, even though I'm diligent, I do a little bit what the senator just spoke to. I do sort of have this automatic system of paying my mortgage. So it's possible that there was a disconnect when the time they raised it and it was due. I can see that. It's possible that they notified me about the $35 increase. I guess I go back to my original point is I sent them their principal and interest. They should have applied it and then come off to me for the extra $35 for the escrow.
No, I wholeheartedly agree with you that at the very least, they have a moral responsibility to apply it appropriately and make you aware. Then
it almost feels like they were trying to catch me, and I don't know why. And I can't imagine how many people get caught up in this. That's what my concern was. Some people can't afford to take a hit on their credit report,
right?
And it might adversely affect them going down the road. And so I thought it was just an unfair practice.
And were you subject to dunning charges of some nature?
That's what really tipped me off. Is they sent me the letter about me being susceptible to other charges, and I had opened it up, and I was like, well, what are they talking about? You know what I mean? So I had to call and ask.
Yeah, because that would truly, in my opinion, be unfair.
I agree. I think the whole thing's unfair. That's why we're here. So I appreciate that.
Well, again, thank you for bringing it forward again. And we have to take a look at what we can actually do legally and go from there.
Thanks for taking it seriously and paying attention. I appreciate it.
we take everything seriously, especially coming from a distinguished individual like you.
Oh, look at that.
I concur with that. Anyone else? Any other questions for Rep. Vitigliano this morning on this? So Representative, thank you again.
Thank you for your time, everybody. I appreciate it.
And we do take it seriously, and we will look at this. And I'd encourage you to keep the dialogue going. You know, any discussions that you may have with the banking professionals. I know the Bankers Association and some others might be on today. If we can help to facilitate those conversations and come to you know, some understanding on this, even if there are limitations because of the law, then, you know, happy to entertain anything that would be helpful. So thank you again. Okay. Next on our list, we have Michael Harris, who's going to be followed by Art Corey. And I believe I see Mr. Harris in the room with us today. Hello, Mr. Harris. Good morning. I think you're still muted. I can't hear you.
My machine or
That's better. Yes, we have you
okay. All right, we'll try that
Great.
then. So thank you
Good
so much
morning.
for my name is Michael Harris.
Now, unfortunately, Mr. Harris, you're frozen on us. I don't know if that will resolve itself quickly here. I don't know if you can hear us. Oh. Mr. Harris, are you there? I can see you again now.
Yes, I'm sorry. Did it freeze up?
It did, but now you're back.
All right, I will start again. I'm so sorry. Michael Harris, Deep River, Connecticut. I'm speaking as a member of the public in support of an act concerning a public bank, HB 6323, I believe it is. We did get some conflicting information about this meeting and this hearing. I didn't expect to speak, so I'll be very brief. And I see you're looking to see what I'm talking about. So,
yeah, Mr. Harris, yeah, that bill, I believe, may not formally be on our agenda this morning. It is. The
agenda provided through the website, as far as yesterday, showed it on the agenda, unless it was changed since yesterday.
Yeah, so the agenda you may have been looking at was for our committee meeting. We had a committee meeting earlier this morning to formally reserve the bill for public hearing time at a future date. And then we had our public hearing agenda, which has other bills on it. So I would invite you back once we have that bill on our public hearing agenda. But I'd also invite you certainly to use your time this morning to speak to us, and then you know, like I said, come back once that bill is formally on the agenda.
Okay, thank you so much for that. I think that might explain the reason why we got some conflicting responses and why I'm in this Zoom meeting and why I was allowed to become a panelist. So I am, just very quickly, I support the bill on public banking, and I encourage you to move forward. Public banks would strengthen the financial position of local governments and local financial institutions, because they would not supersede those institutions, they would support them. And they would facilitate a just and speedy economic recovery for Connecticut, address much deeper systemic issues of economic, social, and environmental injustice. And they would do that by using the power of money creation to lower our cost of borrowing for public projects and projects that serve the commons. Locally, you can avail yourself of more information of this advocacy at a website called publicbankconnecticut.org. And from there, that would be a portal into a national effort to raise this issue in every state of the country. Right now, North Dakota is the only state with a public bank, and you can also learn more about the wild successes that they've had with a public bank there. And we believe the time is long overdue for Connecticut to benefit the same way. So thank you for letting me say those few things, and thank you to the sponsors of the bill. I urge you to move it forward.
Thank you. Thank you. And again, sorry for the confusion, and we invite you back at a later date when the hearing is formally scheduled on that particular issue.
Yep.
Okay.
Thank you again. I will look for that information. Thank you.
All right. Next, I have Art Corey on the list, followed by Rafi Podolsky.
Thank you, Mr. Chairman. Can you hear
Attorney
me
Corey.
okay? Can you hear me okay?
Yes, we can.
Okay.
Welcome.
Good morning. Thanks. Good morning, co-chairs Kasser and Doucette, ranking members Berthel and Delnicki, vice chairs McCrory and Gucker, and members of the committee. I'm Art Corey, vice president and general counsel of the Connecticut Bankers Association. We've submitted several pieces of written testimony for the bills on today's agenda, but I'm only going to speak to a few. The first I want to talk about was HB 5214, partial mortgage payments, but I think I'll shortcut that, my testimony on that. Chairman Doucette, we echo the comments, concerns that you had, particularly about selling mortgages, the ability of banks to sell mortgages into the secondary market. We're concerned that that bill might have a negative effect on banks' ability to sell those mortgages. So we echo those concerns. Next is House Bill 5609, concerning the release of insurance proceeds when a home has been damaged. We're concerned here that the bill will require the premature release of insurance proceeds after a homeowner's home has been damaged and there's been a claim. Normally, as it occurs now, funds are dispersed by the insurer, the lender, incrementally as repairs to the home progress. This ensures that the funds actually go to paying contractors as they repair the home, and that of course protects the value of the collateral, which protects both the lender and the homeowner. So we think the current system should continue to work the way it does. With regard to House Bill 6369, this is forms of payment that a bank would be required to accept when there's a mortgage payoff. Our concern here is that by mandating a list of types of the forms of payments that a bank has to accept, this is going to take some flexibility away from banks to choose or select payment methods that are more efficient, that process the payments more quickly, but perhaps more importantly, methods that are less prone to fraud. We all understand the exploding nature of fraud, including with regard to the settlement of mortgage closings. So we'd like to have banks continue to have that flexibility to address those fraud concerns by choosing payment methods, payoff methods that are less prone to fraud. With regard to House Bill 6370, reinstatement payments, mortgage reinstatement payments, disclosures, and fees. Here, we think that there is federal law and regulation that pertains to the prompt crediting of payments, including reinstatement payments, and the disclosures about how to reinstate your mortgage loan. We think those federal laws and regulations are adequate to protect consumers presently. So we're not sure that there's really a need to do something here in Connecticut on that level. Finally, the last bill I want to talk to you about is House Bill 6372, involving the execution on funds in a judgment debtor's account. And we're talking about natural person, individual debtor accounts. So this bill, we think, unreasonably expands the list of the exempt funds, the exempt direct deposits that would go into a customer's account, the judgment debtor's account, that the bank is required to automatically protect. As you know, there's a laundry list of exempt property and exempt funds under a separate statute. But the execution statute requires a bank to identify and protect a smaller number of direct deposits when they go into the account. So when a bank receives an execution, it has to look and see if any of these types of direct deposits, and what we're talking about here are federal benefits, wages, and unemployment compensation. The bank has to look, find those, and if it sees those, it has to protect a certain amount of the money from those types of direct deposits. What the bill will do will increase the list to any funds that are exempt under that separate property exemption statute. That could include alimony, certain retirement payments. And the difficulty here that banks have is in identifying these direct deposits. It's very easy to identify federal benefits, for instance, that come in because they're marked by the federal government as clearly as federal benefits. And so banks can very easily identify those and they won't make a mistake. The operative phrase in the statute is that the bank has to protect these funds when they're readily identifiable. The problem is that's not really defined. So banks are often left unsure, particularly with respect to wages that are now protected, as to how to identify those. How far do they have to go to try to identify those? If we expand this out to these other types of deposits, it's going to put the banks at risk. They walk a very
Attorney
fine
Corey,
line.
I'm being told your 3 minutes is up. I'm not
Okay.
sure we're using a buzzer. We're still
I
figuring
will
all that
end
out.
it.
But
I will end
but
it there.
I have some questions. If you want to sum up, I don't know if there were any other points you wanted to hit, but I do have some questions on that. So if not, we can just get into it that way. So thank you for your testimony. There's a lot there. I do want to ask a couple questions about each of the ones that you discussed. The first one, 5214. I believe you probably heard Bertigliano's testimony.
I did.
Okay, and is there anything in your opinion, short of regulating this activity and applying it to state institutions only? Is there anything short of that you think could make a difference in this in this space on this issue?
Not that I can think of now, Representative Doucette. I understand that that particular issue and that situation and the frustration of that. The issue, of course, is I think you quoted the percentage, 70% of mortgages that originate in Connecticut get sold to the secondary market to investors. And those investors, including Fannie Mae and Freddie Mac, have some restrictions about the acceptance and the application and or of partial payments. And so, to address that situation, I think you'd almost have to address those rules on that level, which I don't think we're going to be able to do here from Connecticut. I can't think of a solution to that now, but and I meant to say this when I made my brief comments. I'm happy to explore those, that discussion and to see if there's something that can be done on that.
Okay. Yeah, no, I'd encourage that to at least try to have another discussion. And as I said, the same to Rep. Bertigliano about that. On 6369, the forms of payment for mortgage release. I look at this as actually not that significant a change to what's already in the statute. In fact, I believe this language is actually borrowed from another section of the statute, which talks about good funds for tender payment on a mortgage release. So I guess what's a question is, what would be your understanding of what good funds are? Because I believe the intent is just to list, what's already current practice as far as good funds being tendered for a mortgage release. Right,
and I don't know what the phrase "good funds" means in the statute. I haven't looked at that particular section or whether that's defined. I think maybe it might not be, but with regard to checks, there is a little bit of an issue there because depending on the type of check that it is, a bank has to make funds available under federal rules before they actually know that they've received final payment, which maybe is what is meant by good funds, meaning that they know the funds are there. And this is how a lot of fraud occurs. And I think Representative Doucette, you probably are aware of this because, lawyers, particularly real estate closing lawyers, can be subject to some of this fraud attempts anyway, in terms of, these fraudsters using checks to then get somebody to, send a wire transfer because the bank has had to make the funds available under the federal rules. So our concern there with regard to checks is not so much fraud. It's the time period of whether or not the funds are available and having to make the check available sooner than when the bank actually knows the funds are good funds, if you will. So there's a little bit, wire transfers are kind of a preferred method, I think, for real estate closings because you know the funds are good funds. You have more of a confidence that the funds are good funds. So, but even there, where there's a lot of potential for fraud with regard to these wire transfers, we want to have banks have the flexibility to kind of decide what to do. But so
yeah, that's the primary issue there is the potential fraud. There's been a pretty extreme uptick in that type of fraud perpetrated by people sending fake wire instructions and impersonating people, and on the internet it's easy to send people information and then there's funds being wired to places they're not supposed to go.
Right.
So okay, and then moving to 6372. This is the exemption from execution. So I appreciate your testimony, and I guess I understand your testimony, and I don't want to put words in your mouth. So to be basically centered on the question of the identification of what's readily identifiable funds. Is that correct? I mean, the CBA doesn't take a position on whether or not, as a policy matter, we should be exempting certain funds and not others. It's more the question of what's readily identifiable. Is that correct?
That's correct. The other exemption statute, has all of these funds already in there as exempt. And the question is that narrow group that we have to identify that come in as direct deposits, electronic deposits, that we have to identify. We have to find them. And if we see them, the banks have to, protect a certain amount under the execution statute. And the question is, do you see them? Are they readily identifiable? And like I said, benefits, federal benefits, very easy to identify. The federal government clearly marks those. Wages, that's a little more difficult. It's these other types of deposits that are going to get added by this bill that we have concerns about, whether they'll be readily identifiable. And the statute makes banks, it clearly says banks are liable to the judgment creditor if they get it wrong and don't take funds out that they should have taken out. And they're also liable to the judgment debtor, the account holder, if they take funds out that they shouldn't have taken out. So if they fail to identify an alimony payment or some kind of retirement benefit coming in because they're not really readily identifiable, that's going to create a very angry deposit account owner who's now doesn't have access to those funds and potentially make the bank liable because the statute says they can be liable. So that's the concern there is, what's there now, that list now is workable. The banks are working with that. Those are fairly readily identifiable. It's the expansion of this that's going to create much more risk and operational problems for banks.
Yeah, and I appreciate that is an issue. I don't have your testimony in front of me. I think we're having some technical issues getting everything uploaded and everything, but I will take a look at it. It is, I guess what I would ask you for, if it's not already in your testimony, if you could send it to us after the fact, is specifically which of those in the bill are not readily identifiable or are harder to identify from the perspective of the banks. I think I understand, you mentioned alimony and some others. So if you could sort of delineate that for us, I think that is an important point. And then I guess my last question is, there's no, from a operational issue, there's no, it's not difficult for the bank to simply identify as exempt $1,000 or less, correct? What we're calling the wild card. That in and of itself, from an operational standpoint, is not burdensome, correct? So that would in fact make make it easier in some respects to identify those funds, right?
Yeah, that's so that general $1,000 exemption, which is wild card exemption, is already there. So yeah, that banks won't have an operational issue there. I mean, I will just comment that, that's increasing the amount that a judgment debtor can protect, and we have concerns over the increasing amounts that the judgment debtors can protect. We think that there's a good balance right now.
Yeah, it would only if there's other exempt funds above that you have to try to identify, in other words, right?
Right.
Yeah. So if not for everybody would it increase, only for those folks who have the 1,000 protected and then other exempt funds potentially above that you guys have to go and try to identify.
But I think if I'm reading it correctly, what the bill also does is for the ones that we have to automatically protect, I don't think it's limiting those to $1,000. I think those are limited to whatever was the full amount that was deposited for those types, like the federal benefits or wages, in also to the account in the last 60 days. And that actually for federal benefits tracks with the federal rules, but with respect to wages, you could end up having somebody who makes a lot of money, a high wage earner, have 2 months worth of deposits in an account, and I think the way the bill is drafted, the bank would have to not touch those funds. So we'll have a little concern there in terms of the imbalance between judgment creditors and judgment debtors.
Right. So some of it may be new, but others, like the unemployment, workers' comp, federal benefits, it's already being done. So that's not increasing anything in terms of what's protected. Okay.
Right.
Okay. Thank you. Other questions from committee members? Other questions for Mr. Corey? He has a lot of testimony, a lot of bills. Anyone? I don't see any hands raised. Anyone else before I let Mr. Corey go? If not, I thank you, Attorney Corey, and I appreciate you coming out this morning. All right, that brings us to Mr. Rafi Podolsky, who's going to be followed by Roger Calistro. Mr. Podolsky, Attorney Podolsky.
Thank you very much. Let me just first ask, can you hear me?
I can.
Okay. My name is Rafael Podolsky. I'm a lawyer with Connecticut Legal Services. I'm here on behalf of the legal aid programs in Connecticut. And I've filed written testimony on 2 bills, Senate Bill 833, which is about deficiency judgments and after repossession of an older used car, and House Bill 6372, which is about bank account executions. The only thing I'm going to say here about 833 is that what it really is simply an update for inflation of an existing statute. It doesn't otherwise change that except to throw in an inflation escalator clause, but it brings it up to date from what the dollar amounts were. If there are questions, I can be happy to answer them. For me, the more important bill is House Bill 6372, which you've just heard about. The background to this is we have a number of funds that are exempt from creditors, and those exemptions hold if the money's in a bank. The issue, as was pointed out, is the bank is actually required not to turn over to the creditor what's readily identifiable, and our statute defines what's readily identifiable. So a lot of this takes place already routinely. Federal law protects the full amount of the last 2 months of Social Security and federal benefits. We protect the first the same thing, but only the first $1,000 for certain state benefits, which the banks have said they do routinely. The 2 primary things that this bill would do is for people who are, these are exempt from execution because they're basic funds for people's living. People who live off of their bank accounts. This is the money they buy groceries with, they buy gasoline with, they buy all the things that are not, they pay the rent with it. If the money is frozen, or if it's given wrongfully to the creditor, then they don't have money to pay bills, and it really destroys significant aspects of their life. So the goal really is of the existing statute, if it's readily identifiable to the bank, then it's supposed to be protected. We're not creating a new protection, it's supposed to be. But the statute understands, as Mr. Corey pointed out, the bank is not all knowledgeable. It has to have some way of knowing. So what the bill does is it addresses in particular several things, but the two most important are these two. First of all, everyone in Connecticut has a $1,000 exemption. And in some states, that is automatically protected in the bank. Massachusetts just last year did this, automatic protection for $2,500. Connecticut has an exemption wildcard of $1,000. The bank knows that everybody has a $1,000 exemption. There should be no problem in saying that that is automatically protected without going through a procedure in which the money is frozen before a protection can be given to it. So that's one thing that the bill does. For those people for whom $1,000 would not otherwise be picked up, say because of Social Security or child support, by the existing system, it protects automatically that first $1,000. Essentially, that means for small accounts that don't even have $1,000 in them, the bank wouldn't have to do any of the paperwork that goes with the alternative under the statute for when the bank doesn't readily know about exemption. The second thing it does is it says that for things that the bank knows are exempt, and if the law says they're completely exempt or says what amount is exempt, then it says, why are we putting $1,000 cap? Exempt the whole thing. Not exempt, it's already exempt. Protect the whole amount automatically. So for example, child support that's paid through the 4D system comes electronically tagged. The banks know about it, and they'll agree, they do know about it. And that's why the statute put that money in for automatic protection. If they know it's exempt, and under the exemption statute, 100% of that money is exempt, then why would you make somebody have to go through a procedure in which their child support is frozen or part of it is frozen, in order to claim more than $1,000? If it's $1,500 of child support, the bank already knows that the whole $1,500 is exempt. So that's the second major thing that the bill does.
Excuse me, that's 3 minutes.
Okay, so, well, then I will stop. I would welcome the opportunity to answer questions. I will tell you, this is a complicated area, and it's always hard to explain because there's a lot to it. And to the extent I can answer questions, I'm more than happy to. Thank you for the opportunity to speak.
Thank you, Attorney Podolsky, and thank you again for working on this issue. You're right, it is complicated. We've had many discussions over my 2+ years here, and I know you've had many discussions much beyond that. So I appreciate you still bringing it forward, and you know, I do agree that exempt funds that are already exempt under the statute, you know, should be protected, and that's why I'm interested in continuing to have this discussion on this issue. My question for you, my main question for you, is the current draft of or the current bill of the 6372 that we have before us. Does it add additional exempt funds that are currently not considered exempt under our existing statutes, either this statute or the, I believe it's 52352B, which lists off all of the exempt property? Does this bill, and I'm particularly looking at I'm a little confused by the conversation on wages. Is that something new? And is there anything else that's being added as new exempt funds by this bill?
No, there isn't. All the things that are covered are already exempt. There is language in there that clarifying the status of wages in a bank account, but that's the only thing that even touches remotely on that category. The exemption statute, which is a different statute, is what identifies what is exempt already. This is really dealing with the procedure that we have for if something is not defined as readily identifiable under the statute, but it's uncertain, then the debtor has to file a claim form, And the claim form, they file it with the bank it sends it to the court schedules a hearing, the judge decides if it's exempt or not, the court notifies the bank. And during all this time, the bank has taken the money out of the account so that the debtor can't use it. And it only gets put back into the account at that point after it goes through that process. And so what the bill is designed to do is to say for certain things that where the bank itself can acknowledge that it knows the money is exempt, don't make people go through that process. And so that's what it's doing, is identifying. And I understand Mr. Corey's concern about other things that are already exempt but may be harder to identify. And that's certainly something I think that could be talked about with the committee as to how to try to address that concern so that won't create a problem for the banks.
That was going to be my other question to you. Sorry to cut you off. It was any suggestions on how to address that problem for those funds that are harder to identify?
Well, there are a couple ways to do it. One is simply to kind of evaluate the objection and to analyze to what extent that really is a problem. But if you assume for discussion that it's a problem, then the alternative way to do it would be to identify, and I think you were asking questions with that in mind, to identify how the tagging of direct deposits electronically comes into the bank and who we in fact picked up all the categories that can be identified. And I'll give you a good example. When the first stimulus payments last year, the $1,200 plus, was not identified in the federal statute as being specifically exempt funds, but they were exempt in Connecticut because they were public benefit payments, and that's already exempt under the exemption statute. The result is that a bank should not have been freezing and requiring a claim form for that, except it's not on the list. Because it's not on the list, the bank was actually required to freeze and do a claim form. As in the end, it actually turned out for a number of reasons that wasn't a problem last year. But you could address that, for example, by adding the category of public benefit payments, which probably all come tagged. But we'd have to, that would be a factual question that the committee would have to look into, and we'd have to get some more information. Same thing's true with workers' comp. Unemployment comp, the banks acknowledged a number of years ago, comes electronically tagged and is readily identifiable. And that's why it's in the statute. Workers' compensation at the time, so this is 6 or 7 or 8 years ago, the banks said they could not identify a workers' compensation payment, which is also exempt, but as being workers' comp. It would make sense to take another look at that, see maybe now the electronics have changed, maybe this is taggable, and then you would add it to the list. So it's not as comprehensive as the more general category of saying if it's readily identifiable, the bank protects it automatically. But it might be another way of dealing with what Mr. Corey has said, because I don't know for sure which other categories, if there are other categories that really are readily identifiable. I've been lobbying on this issue for a number of years, and each of the categories that is there specifically came as a result of extensive conversations back and forth with the banks as to whether they really could identify them. And for example, wages, for years they said they couldn't, and then ultimately it turned out they could, and they agreed. At the time they agreed that they could, and so they were added as an identifiable category. And I think electronics changes over time, and so things may be more identifiable now than they were 5 or 10 years ago. So I would suggest pursuing that as a possible alternative on that piece.
Okay. Thank you. Any other questions from committee members? Any other questions? I do not see any hands raised on the Zoom. So if not, I think I'll thank you for your testimony, Rafi. And we again appreciate your advocacy on these issues and appearing before us today, and look forward to future discussions.
Thank you very much for the opportunity to speak.
Thank you. All right, next on our list is Roger Calistro, who's going to be followed by Cheryl Ford. And I see Roger is with us. Hello, Mr. Callisto. Attorney Callisto, lots of attorneys.
Yes. Good morning, honorable committee members. My testimony is sort of a revamp of testimony I gave a year ago. I'm addressing a 6372 and that portion of the bill that is sort of an amendment of 52598B, which is the execution statute. Presently, if you have a judgment and you bring suit with, and the statute of limitations for that is 10 years, if you bring suit and you create basically a judgment based on the old judgment, you get an additional 10 years, which is coextensive with the statute of limitations for judgments that are not in small claims. My mother ran a nursery school for 50 years, over 50 years in Woodbridge, Connecticut. She turned 96 in January, and she unfortunately doesn't remember a great deal, but what she does remember is the time that when I was a fledgling lawyer in 1979, she had a father, and back then the tuition for the full year was $400 and it's $200 a semester. Well, this fellow decided that he wasn't going to pay my mother. You're supposed to pay it in advance. He never paid it. And so I sent him several letters, being a newly minted lawyer and very full of the power of being a lawyer, I guess. No response. So I brought a small claims action. That was ignored. I got a default judgment. That was ignored. I tried to collect on the judgment. This guy was always a step ahead of me, and maybe I wasn't as adept at collecting things as I was, I've subsequently become, hopefully. So what happened though is I'm reading the paper like around 1988 or 87, and I see that this guy's become a big shot executive with a General Electric in Stamford. So thanks to the existence of the 84 amendment, I was able to bring suit and get a judgment, which kind of is still remembered to this day by my mother. The state legislature back in 1984, Representative Duffy of then District 77 sent support of the act that was passed that there is no reason that someone with a valid judgment should not have the power of the regular Superior Court judgment to enforce the judgment. They shouldn't have a limited time to enforce the judgment just because it's a small claims judgment. Representative Duffy further noted in his testimony that the purpose of the bill is to allow someone with a small claims judgment to have that judgment remain viable in the case of someone who does not have the assets against which the judgment can be levied. But because someone has a judgment and the person against whom he has a judgment does not have funds immediately attachable or upon which an execution can be made, should not mean that judgment lapses in the time period currently in the statute. So the legislature passed that amendment, and as in the case of my mother, against the tuition dodging father, it gives successful small businesses, the types of businesses like restaurants or suppliers or nursery schools would stay in business for a long time, the ability to collect on old accounts. We've seen COVID shutter businesses, and we've seen as a practical matter the extension of the statute of limitations recently to benefit both creditors and debtors. And there would seem to be no compelling reason why, if somebody's fortunes change, I mean, the fact that somebody 10 years ago or 12 years ago wasn't capable of paying a small judgment doesn't mean in the intervening doesn't mean that in the intervening 10 or 12 years that they remain judgment proof. So I guess that's the only portion of the bill that I was addressing, and I, of course, would be glad to answer any questions. So I'm done speaking.
Okay.
I don't know what happened here.
Jason?
I was muted. Yes, I apologize. Thank you, for your money. I was just saying to myself and not anyone else, I guess, that I don't believe this bill it touches at all the statute of limitations or the time period for collection or anything like that. So unless there's an interpretation, perhaps that I'm missing, I don't think that is affected in this bill at all.
I guess like it's in Casablanca, where they talk about the waters, and the Claude Rains says, well, I guess I was misinformed. So there are no waters in Casablanca. So I apologize if I was told that portion of the statute was at issue. And if it isn't, I guess I've achieved my mission.
Any question for Mr. Any questions? I don't see any. So if not, I thank you again for your testimony and for joining us this morning.
Thank you.
Take care. All right. Next up, Cheryl Foreman, followed by Linda Strumpf. Hope I pronounced those correctly. Cheryl, hi. Cheryl, you are muted.
Good morning. Can you hear me now?
Thank you. Good morning. I can. Thank you.
Good morning. Good morning, Representative Doucette, Senator Kaser, and distinguished members of the Banking Committee. Thank you very much for the opportunity to provide oral testimony today in support of HB 6372, an act exempting the execution from execution certain funds in a judgment debtor's account. I am a staff attorney with Connecticut Legal Services and am project manager of our Consumer Law Project for Elders. The Consumer Law Project for Elders provides free legal assistance to seniors throughout the state of Connecticut who have consumer problems. Over the past 17 years, the Consumer Law Project for Elders has helped thousands of low-income seniors with their consumer problems, including elder financial abuse, such as identity theft and scams, and medical debt and credit card debt. As a result, we often provide legal guidance and assistance with bank executions. Our clients generally live month to month on their limited income. We find that most of the seniors who contact us with debt collection issues are not deadbeats who refuse to pay their debts. Instead, they were able to budget their money and pay their bills until something catastrophic happened in their life, like the death of a spouse or loss of a job, resulting in a decrease in their income. Their new limited income leaves them unable to make ends meet. This results in debt they cannot afford to pay. Such debt may lead to suit, judgment, and finally a bank execution. Current law automatically protects specific direct deposited federal and state benefits, including what most of our clients rely on, Social Security benefits. But many of our clients do not know that to be protected, these funds must be direct deposited. So, like Abby, they have their Social Security benefit direct deposited into a savings account, but then move that money to a checking account to pay bills. Or like Rick, who lives in subsidized housing, they get their Social Security benefits on a Social Security Direct Express debit card, then take benefits off the card and put them in a checking account to pay bills. Moving their Social Security benefit to an account where it is not direct deposited opens them up to garnishment. Both Abby and Rick had their Social Security benefits frozen by a bank execution and were unable to pay rent, medical insurance, premiums, and utility bills, subjecting them to eviction, loss of housing subsidy, cancellation of health insurance, and utility shutoff. Under our current exemption statute, $1,000 of the money in each of these accounts is protected, but an exemption claim form must be completed and submitted to the court and a hearing held before the protection applies. HB 6372 would allow this $1,000 exemption to be automatic, thus providing easy access to at least some protected funds so people like Abby and Rick can pay necessities like rent, utility, and medical bills. As you can see from the speakers list, our clients have few voices to speak on their behalf. The collection industry's voice is always louder. They need you. I strongly urge you to support Bill number 6372. Thank you very much for your consideration.
Thank you. Thank you for your testimony, and thank you for providing that real world story to us. That's helpful to illustrate the problem. Any members of the committee have questions? Anyone? I do not currently see any hands up. So with that, I'll thank you for joining us this morning.
Thank you very much.
Okay. Next on my list is Linda Strum, followed by Tim Rourke. I believe I see Tim Rourke in the room, but I'm not sure I see. Oh, Linda is here. Okay.
I'm here, but I'm
Morning,
blacked
Linda.
out. I just unmuted myself.
Right.
I don't know why I'm blacked out. What do I have to do?
Well,
start
there should be
video.
a
Wait a
button.
minute.
It says video.
Yes,
Yeah, there
okay,
you go.
got it.
There
Sorry.
it is. You got it.
Okay.
Okay. Welcome, Linda.
All right, sorry about that. Okay, good morning, Chairman Doucette, CASA, ranking members of the committee. I'm Linda Strum. I'm a practicing attorney. I'm with the Connecticut Accredited Bar Association and here to testify against Bill 6372. Before I get into my testimony, I would like to respond to Attorney Podolsky's testimony and Attorney Furman. I might be mispronouncing that. I apologize. Testimony. First of all, contrary to due respect to Attorney Podolsky, this bill adds 2 exemptions. Okay, the automatic exemption is in addition to 52352BR, which is the wild card. So the wild card has not been eliminated by this bill, but the $1,000, the way I read the bill, the $1,000 has been added. On top of that, they get the $1,000 wild card. So that's $2,000 that's automatically exempt. That's how the bill reads. That's how I read the bill, because they didn't, because 52352BR is not repealed. So first you get the $1,000 exemption, then you can come in and ask for the wild card. That's the way it reads. The second thing is, prior to this, there was a $1,000 cap on wages within the past 2 months. That cap was taken out. Now it's all wages within the past 2 months. So if somebody is earning $10,000 in wages, $20,000, $5,000, $3,000, that's been added. We as a group had no opportunity to oppose the $1,000 when it was added a few years ago. We didn't hear about it, whatever. But fine, that $1,000 automatic exemption with wages has been in there for a number of years. And now what they're doing is eliminating it and saying all wages within 2 months are exempt. So if the $2,000 wouldn't kill bank exemption, certainly exempting all wages would. So Attorney Podolsky was incorrect when he stated that nothing was added. The $1,000 was added on top of the wild card, and wages were increased to all wages within 2 months. As I just want to comment briefly on Attorney Furman. I mean, I've been an attorney for more years than I'm going to say right now, and I've dealt with these exemptions for years. I mean, there could be somebody who takes their money out and it's not automatic. If anybody ever called me or anybody else that I know that's a collection attorney and said, listen, I'm 70 years old and this is from Social Security and I took it from one account to another, we would release it automatically. Wouldn't have to wait for hearing, wouldn't have to wait for anything. All they would have to do is make a phone call if there was something direct deposited in one account and another. Now, I've never come across anything like that. I mean, I'm not saying that Attorney Furman is not telling the truth. She is, but I don't think that's something that is a common thing or that we necessarily have to address, because that is exempt. We don't question that all Social Security benefits, all pension benefits of the elderly are exempt. And if for whatever reason it doesn't show up in the account as exempt, I mean, all they would have to do is call is contact us, and we would automatically say yes, of course, and exempt it. I mean, that's, but I believe what she said, but it just doesn't sound 100% right. Just briefly, I don't want to go through all my testimony. I just want to say that, as I've said before, there are many things that happen before we get to a bank execution. First of all, even to obtain a default judgment in the state now, you need to produce actual documentation. First, we write letters. Then the small businesses write letters. Then we start the lawsuit. Then we get the judgment. Then, as you know, there's a payment order. If the payment order is in effect, we can't do a bank execution. They could come into court and get the payment order lowered. So like I say, $10 a month. After that, we can't do anything. Then you could do a wage execution. If you can't do the wage execution, then you could do a bank execution. You can only do one at a time. Everything that's exempt we have no problem with. Social Security benefits, veterans benefits, workers' compensation, unemployment compensation, that's all automatically exempt. We don't, my time is running out. We don't, or is that right? My time is over. My time-
Yes.
Okay,
It seems like-
can I just say one more quick thing? We had met before a couple years ago to suggest that we'd have an expedited hearing. We had language to that effect. I was just looking at what we discussed in May 2019. You know, we could certainly go back. We're happy to meet with you, obviously remotely, to discuss this. I picked up where we left off in May 2019, and like we were last year before the disaster happened. We're ready to meet with you again. I know I certainly am. Meet with you, meet with Attorney Podolsky, and try to hammer something out. I know we came very close at the end last year because of the death of that your colleague there. You know, it was delayed, and last year it was delayed. We know why. So I just wanted to say that.
All right, thank you for your testimony. Appreciate it. A couple of questions, or I guess, a question on the issue of wages, as I think you heard I alluded to earlier. I do find that a little confusing, and I guess an ask of you, if it could be drafted to clearly, describe what's already in existing law. How could we do that? In other words, to not add additional wages to what's already being exempted. How could we do that clearly? You can answer, and also if you want to submit.
Yes, I would be happy to work on that.
To someone.
We'd be happy to work on that and get you something in a couple days that would be clear. I have the bill in front of me, but I would have to review it and see exactly what we could do. But we would certainly be happy to make it exactly as it was last year, and add in language that wouldn't affect anything, the other exemptions.
And then the other point that you made that I question is that we're adding an additional $1,000, and I guess again, forgive me, I don't see that at all in this draft, and I don't believe that is the intent. The draft of 6372 specifically says the amounts that are exempt pursuant to subsection R of 52-352B, which is in fact that $1,000 wild card. So I guess I'm not, again, I might be dense here, but I'm not seeing that we're adding an additional $1,000 at all.
Well, then you'd have to take out 352BR because it's still in the statute. And then somebody can get the $1,000, and the way it stands now, come into court and ask for the other $1,000. That's what I don't understand.
I don't agree. I don't agree with that at all. I don't agree. That seems to be some mental gymnastics with the statutes there. That I again, maybe it's just me. So I'm happy to take another look at that. But I don't think that's correct at all.
It certainly could be me, but that was how I read it. I saw it because if you look at the form, the 352BR would still be there. So can't they still come in and ask for that? But that's how we read it. I mean, we could be wrong also.
Okay. All right. So that's another thing maybe to follow up and really go through the language carefully. And then just the last thing, a comment I'll say is that, we've had discussions in the past, and we've heard from other, members of the bar who do this work that, well, if you call me, then everything will be fine. And I don't think that is a reason not to clarify or make changes to the existing statute. I just don't think that's anything that we can simply rely on those representations and just say, well, we acknowledge that there may be gaps in the existing statute or areas that are not clear, or you have to file a claim form, even though the statute says it's exempt, but you can make a call, you can file a claim form. I mean, I think there's an interest, certainly on my part and on others in the committee, in clarifying this whole process here. And if there are funds that are exempt, then they should in fact be exempt. But I appreciate your. If
I could just respond to that. I didn't mean to say that, of course, we can depend upon a call. I can't account for every single attorney. What I meant to say is, if it's exempt at Social Security, of course it's exempt. I don't see I just, Attorney Furman's testimony, I'm not saying I don't believe her, but if it's exempt, it's exempt. I mean, I haven't seen a case where they haven't exempted direct deposit Social Security. I mean, transferring from one account to another, then it would be exempt in the other account. I just didn't see that. I mean, everybody now has direct deposit. Nobody gets a check, a Social Security check in the mail that I know of and goes to the bank. So it's all there. It's all direct deposit. It's all exempt. That's what I didn't understand what she was saying.
Right.
I'm not saying make a call. I'm just saying, if it's exempt, it's exempt. I mean, that shouldn't, $1,000, my understanding is $1,000 wild card is above all that. If it's exempt funds, I mean, of course, it's all exempt. No matter how much you get in Social Security.
Right, but I think part of the issue why we're here today is that there are exempt funds that do get subjected to a bank execution because the person has not availed themselves of the court process and filing an exemption form. And so I think that's the issue that we're trying to pinpoint here. But I appreciate your testimony and your input as always. Other questions for Attorney Strump? Anyone else on the committee? Anyone going once, going twice? If not, Attorney Strump, thank you as always for your testimony.
Thank you.
And joining us today.
Thank you.
All right. Next, we have Tim Rourke, who will be followed by Russell London. Good afternoon. Good morning. It's still morning, Mr. Rourke.
It's still morning. Yes, it is. My name is Tim Rourke. I'm here today talking in reference to Senate Bill 833. I am speaking in opposition to that. First off, let me tell you that BCI Financial, which is the company that I own, has been in business for 23 years. We do prime lending to car dealers throughout the state of Connecticut and into a couple of other states, but mostly located here in Cheshire, Connecticut. And we've been doing this for a long time. We understand this business very well. And one of the things that we find is that when we make a loan to an individual, we are working very hard to make sure that we are giving them the right loan for the right purposes. In the case of this particular bill, I think it becomes very detrimental to many of the consumers who are out there. And the reason I see that is a detrimental issue is we're raising the amount from $4,000 up to $9,000. A previous speaker made a comment, something to the effect that it's just an inflation change, which to some extent I do understand in the normal scope of things. But I will tell you that if you had a child who needed a car 10 years ago, you would have gone out and spent $4,500 on that car. If you needed a car today for a child who needed a car, you'd probably spend the same $4,500. It may be a lesser car, it may be higher mileage, it may be an older car, but you're still going to be looking for that. To increase the amount of this threshold up to the $9,000 is going to take a number of lenders out of the market. We know that there is a whole market out there for subprime and buy here, pay here type of companies. Those guys will stay in the market. They'll be happy to take their 18 or 19%. But I will tell you that a number of banks will not stick around in the 9,000 and less market if they know that when the time comes to repossess that car or do anything else, because the threshold was there, they can do nothing more to try to collect that debt. Okay, that debt was made in good faith. The customer hopefully tried to pay it in good faith. If in fact they can't, we want whatever options are available to us. We think this particular bill hurts families. We think that it hurts individuals. We think it hurts military. We think it hurts the elderly. Because what it does effectively is puts them into a completely different pool as far as where they can go to actually get lending for a vehicle that they're looking for. And that pool is not going to be the traditional bank, the traditional finance company that's out there. It's going to be the buy here, pay here, and it's going to be the subprime lenders, because the other banks are simply not going to stay in this business in the $9,000 range, in my opinion. I think this also really does affect people who are looking for new credit and trying to get that credit. You're going to, again, kind of force them, if they're looking for a vehicle in the $7,000 range, they're going to end up forced into the 18% market, 19% market. I don't think that's really the intent here. I think all of you understand that you could go out and buy a car today for $4,000 or $5,000, but to push that threshold up to the $9,000 is going to take some people out of the market. And that's what we're really trying to do more than anything else. This is just, to me, detrimental to the consumer.
Okay, thank you. Thank you for your testimony and your perspective on that. Any questions? I see Rep. Delnicki has a hand up. Rep. Delnicki.
Thank you, Mr. Chair, and thank you, Mr. Rourke, for coming forward. You know, it's interesting. I talked to a number of folks that in the car business and brought that specific issue up to them and asked them how it would affect, you know, young people, elderly, folks that don't make a lot of money, and their sentiment was exactly that this change would actually penalize people, hurt the business, and hurt somebody that's just struggling and needs some kind of decent transportation to get them to and from work. So your testimony to that effect, literally, I've heard it from a number of people that that's what would happen here. Is that a pretty reasonable assumption on my part?
I think it's a very reasonable assumption on your part. I can tell you that right now, if I had someone come to my institution and they were looking for a 2013 vehicle with reasonably good credit and everything else, their rate that they would pay would be about 4.29. That is what they would be getting for that vehicle. So for us to put them into a position that I won't make that loan to them because I have this additional prohibition if I end up having to take that vehicle back. And keep in mind, what percentage of loans do we really take back? 1%, 2%, something like that? It's not like it's affecting a huge amount, but for me to take that risk, I'd rather not. So I will just stay out of that market. So do we really want to, for the 2% that may be affected, really paralyze the other 98% of the market? I just don't think it's a good idea for them.
So this bill, the unintended consequence of this bill is that it actually hurts folks that are struggling and folks that are trying to make ends meet.
It does. I think it's not good for families. I don't think it's good for people in the military, especially at a lower grade. I don't think that it's good for people who are starting out in the credit world and things like that. I think it hurts all of those people as far as kind of pigeonholing them into a significantly higher interest rate without the risk that goes with that rate. I mean, I'm not necessarily against an 18% rate if somebody has done something in their credit history to deserve that. But in this case, they're simply being prohibited by virtue of the amount of the car that they're looking to buy. And quite candidly, oftentimes, if they're spending $8,000 or $9,000, they're trying to do the right thing by buying a car that they can properly afford.
Yeah, I have to agree with you. They're just trying to get something decent to get them to and from work, to the store, etc.
I agree.
And I can also see the unintended consequence because my first banking transactions was with a credit union where I worked. That credit unions try to help the members, but would that actually cause a situation where they might think twice?
I think that it would. I think that you would find them thinking twice about even being in that business.
Thank you for your testimony and raising an unintended consequence to that bill there. Again, thank you.
Thank you, Rep. Delnicki. Anyone else with any questions for Mr. Rourke? I actually thought of one in just looking at the amount, and you alluded to this in your testimony that part of it has to do with inflation, but it may not have the same effect that one would think with regard to the customers and the type of vehicle that they're trying to purchase. Do you think, you know, in the name of just inflation, since I believe it's represented us that the last time this statute was updated, or I guess first enacted, perhaps even was back in the 70s. Do you think there is an amount that would even be appropriate to sort of modernize this?
The only reason I can't necessarily say yes is that I still know that there are vehicles out there in the $4,500, $4,000 range. that people would like, especially, as I said, I mean, to me, the one I go to and I typically look at that where the properly credit-worthy person is oftentimes a parent who's trying to help their kid, maybe even just a high school kid or something like that. They can buy a $5,000 car today. And it's a reasonably good car. It may have a lot of miles on it, but if you remember the 70s, a car with 100,000 miles on it was basically done. A car in the 90s or the 2000s, a car with 100,000 miles on it is only through about maybe 2/3 of its life, but more likely just half of its life. So I don't know that there's necessarily an even way to look at that from an inflation adjustment. I mean, I suppose, if you went to $5,000, I wouldn't say that that's the end of the world. But I think even the inflation adjustment that's in this bill is not a great idea because I don't think that it's typical like a normal inflation type of index that you would use. Cars will still be out there for those prices and cars have changed.
I appreciate that. All right. Well, thank you for joining us today. Appreciate your testimony. And thanks again.
Thank you.
Take care. All right. Next on my list is Russell London, who I'm not sure if Attorney London. Oh, I do see him. There he is. Attorney London, thank you for joining us. Welcome.
Great. Thank you, Chairman. Chairman Doucette, Chairman Kaiser, ranking members Delnicki and Berthel, and distinguished members of the Banking Committee. I thank you for the opportunity to be able to testify today. My name is Russell London, and I'm a member of the Connecticut Creditors Bar Association and co-managing attorney at London. We're a small law firm located in Newington, Connecticut. We've been around for over 20 years, and my dad was a practicing lawyer as well. Our firm is a full-service business law firm with a focus on creditors' rights and remedies and recoveries. We represent a number of small businesses, family businesses, and sole proprietorships and condominium associations in Connecticut, in addition to a number of banking clients. I'm here today to testify in opposition to House Bill 6372. The proposed legislation, which is a reincarnation of previous bills, has been presented in part, places an undue burden on businesses struggling to survive and stay in business, entrepreneurs trying to get ahead, and single mothers seeking to enforce financial support orders, and others who are lawfully owed money and who have obtained a judgment from the Connecticut courts. In short, money judgment issued by a court would be worthless or almost worthless if the judgment creditor does not pay and if there is no legal mechanism by which the prevailing party can execute successfully on a judgment and get paid. My colleagues who have spoken and who will speak will probably go into more of the mechanics, so I want to summarize rather than get caught up in all the details of my written testimony. My summary goes as follows. One, the bill's not needed. There's already adequate safeguards in place to protect people, and there is the wild card $1,000 exemption. If anything is needed, is maybe a faster way to get to a court hearing, but nothing should discourage someone who has, nothing should encourage or someone who has not paid a bill, ignored a judgment, not comply with any nominal small orders from not having to at least speak up and talk to the creditor. And I think this bill would encourage people just to keep sticking their heads in the sand. Second, this bill would reverse the unanimous court decision of Cato versus Fletcher, in which the Supreme Court has spoken about wages being deposited into the account. This bill would make wages, and I disagree with Mr. Podolsky on this, is that it would make wages exempt unlimited amounts. So in the case of Fletcher, over $300,000 was deposited into an account, and the Supreme Court said those funds were not exempt. But the debtor tried to say they were and tried to not pay their creditors. The bill is similar, also third, this bill is similar in many respects to HB 5491, in which the judicial branch spoke up and testified that it would impact the collection of past due child supports. I think this is important because those people are really the ones that are often really struggling and who are trying to make ends meet and to pay for their kids' expenses, and to take away someone's ability to do a bank arrangement where most of the time there's less than $1,000 in an account would really impact them. And it would not encourage talking. We often find that when people have to come to court and talk, good things happen. Payment plans work out, that people feel that they've empowered, they've accomplished something, and it's helped make them get on top of a plan that allows them to succeed. Fourth-
3 minutes, sir.
Okay, is that my 3 minutes?
Yes,
That's your 3 minutes. Yeah, you can
Very good.
briefly
Well,
sum
if you
up
have
if you want, or
questions,
we
you can sum
can
up.
go into questions. Okay, I guess I'll start. I have one question. I think you characterized this bill as making a judgment worthless. I think that seems to be a little bit of a stretch. This does not make that judgment uncollectible. Is that correct?
Well, I think what it makes it has no teeth. I mean, this is an important tool for creditors or plaintiffs to use as their box of remedies.
Right, but it doesn't.
If someone's not
We're not
work-
abolishing. It doesn't abolish the bank exemption as a tool.
It doesn't abolish it. It effectively abolishes it, because 88% of our executions where we do collect money, the amounts are less than $1,000. Also, people can put their amounts into multiple banks of less than $1,000, and this new procedure would allow them to effectively shield from collection a legitimate obligation. So it doesn't.
Okay, but you have other methods to collect. There are wage garnishments, correct?
Wage garnishments does not apply to someone who is self-employed.
There's property executions, correct?
Rarely is a property execution used. Property execution will be used maybe against a business that might have a till
and
or something like that. But property executions in my 25 years are rarely ever used. It's usually when someone has an asset, a boat or something big that someone can go after.
And what time period do you have to collect on these judgments?
In small claims, you have 10 years unless you refile them. In Superior Court, you have 20.
20 years, okay.
And often there's no interest on a lot of these judgments being awarded by the court. So it really hurts the poor business that is struggling to meet payroll, or the person who has children to support, to not be able to have an effective means to get paid.
I do appreciate you bringing up the child support issue and the that Cadle versus Fletcher decision on the wages. I think that is something that's worth looking at. Any other questions from the committee members for Attorney London? Tom Delnicki, Representative Delnicki, excuse me.
Thank you, Mr. Chair. And Russell, thank you for your testimony. Or should I say Attorney London? Could you go a little deeper into how this would affect minority and women-owned business enterprises and small local business enterprises? Because you touched on it, and I think you ran out of time.
Sure. Usually those people are the ones that are financially strapped, if anything more. They're really on the brink of succeeding or not succeeding, and every dollar is very tight from these businesses that I see. Often they're the new businesses or they're smaller businesses. I have a client that has a lawnscaping business. He's a special needs adult, and he does lawn mowing and snow plow removing. And he did this for a number of clients who decided they weren't going to pay him. And he said, tough luck. And so, we had to look into help him out. But the bank remedy would have been maybe the only remedy that they would have had to get paid from individuals, not from companies, but from other individuals who owe money and may not have things. I've also seen women who contact me in frantic saying, I'm owed money. I had a woman say that she was a school teacher. She had been in a relationship with a man for over 5 months. He asked to borrow money for her as a down payment on a house that he wanted to renovate. The deal didn't go through, and the money was miraculously gone. She wanted to get it back. However, when she contacted the person, he says, you're going to get nothing. I don't work. I'm self-employed. You can't attach my wages. Good luck. And when we looked at the court website, we found that he had done this to other people. So since the person is self-employed, you can't wage garnishment. And the only way you're going to be able to do this is through a bank garnishment. And if the person places their accounts into multiple accounts, it's tough. But to get to your point, I have another business, which is, that is an LBGT business. And that business has payroll to meet and has expenses to be able to take care of. And if that business can't collect on monies that are due, it's going to make it very difficult for them to stay in business. And those businesses often are a lot of hardworking individuals who do their job, who do the services, try to help other people out, get promises to pay, and then they don't get paid. There are many avenues in our current system where people can get involved and speak up and do something and make payments. And all you have to do is just file a motion for a modification of a court order. And you'll be before a judge, a magistrate, or a judge to have it adjusted. And often we get called, we work out agreements amongst these people, and we get them to make payments and they adhere to it. But still getting back to your issue, there's single moms who don't get paid. There are people who get taken advantage by contractors that sue. All these people need ways in which to be able to collect. And when we find that about 88% of the time we are collecting less than $1,000 in a bank account, by making it automatic and not requiring the person to come to court to talk to the judgment creditor, really flies in the face of fairness.
You said something there about going to court to get people to talk.
Yes.
So the unintended consequence of having this bill would actually reduce the chance for a dialogue to occur between a debtor and someone that owes the money, that needs to collect the money, I should say.
Absolutely. Often the person who's the judgment debtor puts their head in the sand, they don't pay attention. But when there's a bank arrangement where they can come into court and get a chance to speak to the plaintiff or the plaintiff's representative, a deal will be worked out. It's almost, I would say 95% or more of the time our deals worked out amongst people, and it's a productive conversation. It would, if this bill goes through where someone doesn't even have to do anything, they're automatically given an exemption. They don't have to file papers. They don't have to talk to the creditor. It really helps precipitate non-responsibility. It would eliminate that dialogue, and that's really important. And even what I find is people are really happy who are defendants when they have a chance to take charge, find a plan, work with the plaintiff, and successfully come up with an arrangement that will work.
So just to make sure I'm clear on this, the unintended consequence here is actually creating a wild card where no one will talk about the issue. There'll be no negotiations, and the debt will just sit out there, and the small business will be basically unable to get any resolution.
Yes.
Whereas if they had to go to court, at least the dialogue could begin.
Representative Nicky, I could not agree with you more. I have a child that's in school. You try to teach responsibility. And what I found from my experience is when the parties talk and they come up with a plan, everyone's happier. But when you basically say the state allows, you can hide that there's no consequences or there's no effort to resolve it, it's bad. I mean, Connecticut, fortunately for a lot of people, has a very small nominal order when a judgment's granted. And the person only has to pay $35 a week or less to be able to not have any executions come after them from small claims proceedings. So we want people to communicate. We're all in favor for expedited hearings. We're all in favor of communications. We want to work with people. We're Connecticut-based. We understand that things are tough. But taking away the only avenue that we can get people to come and talk to us is really very hurtful for businesses and often allows a bill to go unpaid.
So then the real loser here could very well be that one or two person women-owned business enterprise, minority-owned business enterprise, or small local business enterprise.
Exactly, and others too, but I don't want to divulge any names, but I hear many businesses say, I'm struggling now, trying to meet ends meet, and we did the services, we provided the things. I have a lot of very valuable employees, and we're just trying to survive. And if you take away any way that gets people to force to talk to, great. We come to court often, and if someone shows us that they have a permanent hardship or they have a situation, at least we know, we don't waste our time pursuing that person. But to not allow someone who has a means or an ability to be able to pay something really strikes as an unfair situation.
Well, I thank you for coming forward today. I appreciate your testimony, and obviously it puts a different view on the merits of the bill.
I think communication is so key, and we like it. And you find that when you get win-wins, everyone succeeds when you get talking amongst people.
Thank you, Rep. Delnicki. Thank you. Any other questions for Attorney London? I don't see any hands raised at the moment. Just one more. I don't want to keep you here all day, Attorney London. We've got other folks to testify, obviously. But I think it bears some clarification because the issue is confusing. And to listen to your exchange with Rep. Delnicki, again, it makes it sound as if this bill would be providing that automatic wildcard exemption that is not already there. Is it your contention that there is effectively no wildcard exemption that's available under law without going to court? Because that's not my reading of the statute at all.
I think you have to claim, there are a number of exemptions that you can claim on the form. But
my question is to you, is it not already our law that that's an automatic exemption? Where does it say that it must be in the statute, that it must be claimed on the form and that someone must go to court to avail themselves of that exemption?
Yeah, I don't read the statute saying automatic. I read it as something that can be claimed. And you know, often what happens when we go to court,
but where does it say claim in the statute? Where does it say?
I looked at the form, affidavit of claim of exemption established by law. So someone has
that's not the statute. And that's my whole point, that the statute should be clearer so that there isn't this, frankly, loophole in the process, which says that automatic exemption, which exists in statute, is only available to you, and this is not in statute, is only available to you if you go find the form and show up in court to avail yourself of that exemption that's in the law. So it seems to me that it's often misrepresented that we're creating a brand new exemption with this wild card, when in fact it's already there, and there seems to be a loophole in the existing procedure which says that you have to go to court and claim this exemption. So I guess I just want to clear up confusion on that, because I think there is quite a bit of confusion on that.
You know, by not having someone come into court, you're eliminating the dialogue. It is an exemption people can claim, but you know,
and as I talked about with Attorney Strump, you know, the dialogue is not something as well that we, you know, is in the statute itself. You know, it's all nice to say that we can talk about these things, but that's why we have. That's why
the person may not want to avail themselves of the $1,000. Often people have ignored a judgment, and then they say they get an execution. Oh my goodness, it's there. I will let that money be used to pay for this.
Well, that's a supposition, of course. So
that does happen a lot. Or there's a deal made that maybe a certain amount will be given back to the person, and a certain amount will be applied to the balance. So I don't see it as being automatic. I see it being claimable. And you know, we may, you know, read things a little bit differently, but I think it's important. We get to the importance of the thing is responsibility. You know, people take on an obligation to pay and being able to walk away. And that's really what I would encourage you to focus on. Also, the big thing about stacking, you know, people have 5 bank accounts and each of them have $1,000 or less. There really needs to be able to a chance to canvass the person to say, all right, you have this exemption, but you have other bank accounts. So they don't get a way to perpetrate some kind of scheme or fraud.
All right. I appreciate that. And again, thanks for being involved in this discussion, and appreciate your testimony this morning.
Okay, thank you.
Thank you. Okay. Moving on. Next on our list, we have Attorney William Marone, and to be followed by Mike Simcoe. Is Attorney Marone here?
I am.
He is. Yes.
I am.
Hi.
Good morning. Still morning. Yes, 4 minutes. So snuck it in. Chairperson Doucette, Chairperson Kasser, ranking members. Thank you guys for the time. I also would like to thank the clerk of the committee, because seeing now that I'm inside the room, this is like producing the Super Bowl halftime show. So if this is your first time, it's only going to get better. So thanks for making a workable situation out of something that's not ideal for everybody. Before I get to the meat of my testimony, Chairperson Doucette, I wanted to address Senate Bill 833 and a question you asked to Mr. Rourke. It was in regards to the inflationary piece of the increase in the base value for a deficiency judgment. In 2016, it went up from 2,000 to 4,000. So there has been a relatively recent change. It didn't track all the way back to the early statute. So I just wanted to bring the committee's attention to that. There's a second piece that I submitted written testimony on, and that's Senate Bill 4228, sponsored by Senator Abrams. Somehow my life has gone off the tracks in this nuanced little issue of interest on obligations in Connecticut has sort of become the thing that I live in. Representative Delnicki had asked about any controlling case law. There's two statutes and two tracks. And Senator Abrams, there's a word in her raising of the bill that's actually not in the current statute. And she spoke to the word judgment. The statute isn't limited to just judgments. It's interest, non-usurious, on all obligations, pre and post maturity. So I just wanted to offer that little clarification, because Connecticut's framework is different than other states. So we have two competing statutes, and I'd be happy to submit to the committee, if they have interest, any information on that topic. And I outlined some other things in my testimony as well. And in opposition to House Bill 6372, the bank garnishment statute, to steal from Senator Kasser's opening comments to Senator Abrams, clarity is key. And I understand that there's a disconnect. And Representative Doucette, two quick things. One, you are correct. It does not eliminate any rights to collect. It just changes it. What I hear from everybody is there's a lot of agreement on the what. Exempt funds should be exempt. Where I see the disconnect is on the how. And Attorney London's comments are interesting, because the statute and the piece that we're seeking to touch, and the reason that sometimes our members may have a difficult time talking about it, is the bank's obligations. So when we think of our piece of it, we're on the back end after the bank has already fulfilled their obligations. So sometimes I think that we only see it through our own eyes, and we see it, well, of course, here's the exemption claim form and all this other stuff. But it's really the bank that has the obligations on that. So one of my clients will be submitting testimony later today, Diana Pfeiffer from Sikorsky Financial. And I read the statute to create and overturn the Cato versus Fletcher case that Attorney London spoke about. And I think that's problematic, because as Attorney Corey said during his testimony, the bank only has certain information. And so exempt wages is what would be unable to be touched if readily identifiable through direct deposit. The problem is, and my client's testimony indicates the calculation necessary to get to exempt wages, is they have none of that information. They don't have the gross payment amount. They don't have the federal deductions, state deductions, or any of the other things. So I see that my time is up. I am happy to answer any questions. And I really appreciate, because on all the bills, the one thing I've heard from the committee is a willingness to talk and discuss and try to get to the correct how. I think we're all rowing in the same boat on the what. Now let's just figure out the how. So I appreciate your time, and I'm happy to answer any questions.
Thank you. Appreciate your testimony and touching on all of those things in your 3 minutes. Well done. Any questions for Attorney Marone from committee members? Anyone? No, going once, going twice. If not, I appreciate your time, and again, multitasking in your testimony.
No
and I'll say good afternoon because it is afternoon now.
Thank you very much.
Okay, take care. Okay, next on my list is Mike Simcoe, who will be followed by Bruce Adams. Mike Simcoe. Is Mike Simcoe here? No. Okay. If not, we can, if we just missed him, perhaps circle back. So I will ask Bruce Adams to appear before us. I see Bruce's background and now I see Bruce. Okay. Welcome, Bruce. Bruce, you are muted though. There you go. Welcome,
I've
Bruce.
lost mute bingo. Well, one of the benefits of going later in the list and testimony is you get the opportunity to edit yourself down, and I intend to do that for you and save you some precious time. Because with essentially all of these bills, we're aligned with the bankers on these issues. And we don't need to repeat, what's in my written testimony and theirs. But I'd like to key off on a couple of items. And I should also say, where is my sense of protocol? Good afternoon, Chairman Doucette, and good afternoon, Chair Kasser and ranking members in the Banking Committee. My name is Bruce Adams, and I'm the President and CEO of the Credit Union League of Connecticut. I think that the most important piece that I'd like to communicate to you all is that with respect to all of these bills, and frankly, the bills that are going to come later in the session, is that credit unions, by and large, as they descend in asset size, also descend in their ability to adapt to legislative changes like this. So your typical financial institution likes to have certainty and protocols so that they can treat everybody consistently. And that's a spirit, the spirit and the law of the regulatory regime. When it comes down to, for instance, the Connecticut State Prisons Credit Union, the Connecticut Department of Labor Credit Union, the Faith Tabernacle Baptist Church Credit Union, these are very, very small institutions that take 6372, for example, identifying what is readily identifiable to a financial institution that's $8 million in size with 2 or 3 employees is very different than what Webster Bank can do. And so as you consider these various pieces of legislation, I would ask the committee to consider that these smaller credit unions will need additional time to figure out and comply. So for instance, when in the first round of stimulus funding, those direct deposits, right, federal benefits should have been easily identifiable. But because they came coded from the IRS, many financial institutions thought they were tax refunds and dealt with those funds differently. And so it's one thing when you can recode it into your system and have it grab those payments based on time. It's another when you have to, do that process manually. Similarly, on the post-judgment interest bill, for the small credit unions, they may think, oh, geez, maybe I can't enter the credit card space this year because now I don't know if my interest rate is going to get, slashed. And what these small institutions will do is decide quickly because they have to move on to other operational needs. So I'm trying to put sort of a lens of context on top of all of this legislation holistically, rather than pick apart these various pieces. My testimony is in writing is submitted to the committee, and you can look at that. And I think I would mention also that in 6369, with the mechanics liens, of course, we like the option to release the lien by substituting a bond. But as has been mentioned here before, there has been a huge uptick in fraud, really, as this pandemic has gone forward. And I can't remember who testified earlier about it, but the issue is not the form of payment, but the timing. between, the negotiable instrument and the receipt of the funds. And a lot of mischief can happen in the interstices between those two moments. So I agree and concur with that testimony. I feel like I'm over 3 minutes, but I haven't gotten the high sign. So I'm going to stop, and I'm happy to field questions from the credit union's perspective.
Thank you, Bruce. I appreciate that, your brevity. I am having a hard time tracking the 3 minutes myself, but I appreciate that.
You just made it.
And again, thank you. And again, for hitting on a number of topics. And I guess the only thing I would ask to you, is I also asked of Attorney Corey, I do appreciate, and it's a very good point about the identification of deposits. So I see your testimony here, but if you wanted to supplement that, I would invite you to, with any specific types of deposits that are more problematic than others, or any that are identified in the bill, with specific examples of how those are problematic. I think that would be extremely helpful for us. And
I'd be happy to do that, Representative Doucette, and also to consider when we do that, we will put a context on it about whether it's readily identifiable by a human is different than readily identifiable by a core, computer system. So we'll add that context into.
Yep. No, I appreciate that. It is valuable. Okay. Any other questions for Bruce? See Rep. Delnicki with his little yellow hand up. Rep. Delnicki.
Well, I have to have it match my tie. Yeah. So Bruce, you spoke to the burden some of these proposals make to the small credit union. When you say a small credit union with, say, $8 million in assets, how many people actually work there in a small credit union like that?
Well, I'm resisting the temptation to say the joke about half, but I think that credit union itself has 3 employees, 2 of whom may actually be board members.
Yeah, I sort of surmise that because when I started out as a board member at the Metropolitan District Employees Credit Union, that's what we had. Actually, we had 2.5, 2 full-timers and a part-timer. And based on what you were saying, the fact that a small operation like that, or even some of the medium-sized operations, which are, the credit union provides a lot of benefit for the first-time borrower, first-time depositor, and underserved communities. So for them to have to deal with some of these proposed regulations, it would be a real burden for them. Is that a fairly accurate comment?
It's more than fairly accurate. I mean, what we have to remember is that with credit unions being financial cooperatives, the money from the depositors provides the capital to fund the loans. So there is no outside injection of money. And what that means is every dollar that's spent on operations is a dollar fewer that can get back into the hands of the members in the form of more competitive interest rates. So that's another reason why we're looking to open up the possibility of association health plans to let credit unions drive their healthcare, fixed healthcare costs down. And so, and look, when it comes to a judgment, an execution, you got to comply with the law, and credit unions are regulated institutions and they will meet that challenge. But those one-off burdens are not, have much more of an impact on a credit union, some small credit union, than a bank that has a team that's able to do that. And specifically, I think of one of the credit unions that is focused on one of the first responder groups in the central part of the state, was, substantially larger than 8 million. I think it's about 50 or 60 million. And its profit margin this year was $40,000. for the whole credit union. So when we talk about, the deep pockets of a financial institution, and the bankers have small ones too, right? The deep pockets get a lot shallower the smaller the business gets. So dealing with new regulation, new laws, while appropriate in many cases, has an outsized impact on the smaller institution.
Well, I thank you for your perspective on that. And I've got to be perfectly candid. The small credit union is one of the greatest assets we have in banking, especially for folks that need a place to bank with, don't have a substantial amount of resources, and can't afford the fees that some of the larger institutions have. And
well, thank you,
I
Representative.
really appreciate the credit.
Thank you. And as a former regulator myself, I appreciate both your comments and the fact that we have a banking system in this country that allows for the small credit union and the large bank, and state regulation and federal regulation. And that's what keeps our system stable. And in Connecticut, we are lucky to have a collegial relationship with the bankers and not acrimonious like it is in some other states.
Again, thank you. And thank you, Mr. Chair.
Okay, thank you, Rep. Delnicki. Anyone else with a question for Bruce? I think that's it for today, Bruce. Again, I appreciate your testimony. All the testimony's now been uploaded, and so we have everything here. I appreciate you multitasking on our agenda today, and we look forward to seeing you again soon.
Thank you.
Thanks.
Bye.
Okay. Next on our list, I have Eric Open. Eric Open. Is Eric here with us? Yes, I see Eric.
Hi,
Welcome,
how are
Eric.
you?
Good.
Sorry, I've been working with the kids today on a school snow day.
Yeah.
Good afternoon again. It's once again before the banking committee hearing. My name is Eric Open. I'm an attorney based in Milford, Connecticut, with approximately 2,500 cases, a variety of small businesses, including construction companies, medical providers, basically small businesses that are less than 10 employees that are heart and soul of America. And I'm not going to speak to the specifics of the language or anything, but I want to really address some of the practicalities that I think Attorney London really talked about at length, and specifically relative to the small businesses. I mean, when you do a bank or a wage execution, it is a last resort. Our clients are not necessarily happy to come to us and see us. They have a problem. And while you can speak to the problems of debtors, my clients have the same cash flow problems that debtors are undergoing at this time, and they've always been undergoing cash flow. Most of them will work out a deal, but again, the key is to pick up the phone and call the office. We're not here, my client wants to work out a deal, and often these deals are interest-free. And I think it's important to understand that the clients are losing out on that. They provided a service, often have to wait up to 2 years to get their day in court. And again, it's something that they don't want to get to, but it's something that they deem necessary, as a way of checks and balances within the system. They're the ones that are providing the responsible credit and providing the services. And then they're caught behind the eight ball a lot of times through no fault of anybody's necessarily. But again, it's just a last resort. And I think you need to understand the issues of cash flow and why that matters to the clients, because they are giving out an interest-free product and an interest-free loan specifically. And it's really important to understand that. And I would also point out the fact that if you were going to do something automatic, there are debtors that may want to work out a deal. And that may be for specific reasons of credit reporting issues that I think it's very important to understand. So I just would throw these issues and indicate my client's objections to House Bill 6372. And if there are any questions, I'll be happy to take them. Thank you.
Thank you, Mr. Urban, for your testimony. Are there any questions from the committee? I don't see any hands raised at this time, so thank you so much for coming to testify.
My pleasure.
And we're going to move on to Michelle Fika. Is she with us?
Can you hear me?
Yes, I can hear and see you. Welcome.
All right, thank you. Representative Doucette, Senator Castor, thank you so much. Other members of the Banking Committee. My name is Michelle Fika, and I'm an attorney at Connecticut Legal Services. And I've already submitted my written testimony since we don't have a lot of time. I'm going to focus on addressing some of the concerns that the creditors' attorneys had brought up. But I've also included in the written testimony a chart, which I really hope that you'll look at, because I try to lay out the process, how it's supposed to work if someone is actually going to successfully claim an exemption. And I hope that you can see how difficult it is and how arduous it is for my clients who are extremely low income, don't have all the skills, the regular mail, all these things that you really need to, it's not an easy process. I've actually helped people do it. It's not an easy process. And so I hope that that chart can help explain just how it's supposed to work, but then also all the ways that it can go wrong. And so again, it's because my time is limited, I'm just going to focus on some of the points that were made by some of the creditors' attorneys. The first one was that Mr. Corey had argued that this would increase the list of types of funds that banks are required to identify, to a list that's difficult to identify. And I want to just point out that there's nowhere in the bill that changes the definition of readily identifiable in terms of the electronic deposits. And this is something that's, it's been working out as well as can be expected. I'm sympathetic to the idea that there are going to be some deposits that are not easily readily identifiable. And what I would say in response to that is that there's also a good faith immunity built into the statute already, which says as long as banks have reasonable procedures and they're trying to protect funds that are readily identifiable, they should be fine. So this is really not something that's going to be increasing the risk to the banks. In terms of wages, a few other speakers had pointed out that it would kind of make wages, it would kind of expand the exemption so that basically all wages are exempt. I would like to point out again that the bill refers to readily identifiable exempt deposits of wages. I'm sorry, I already got to 3 minutes.
3 minutes if you could wrap up.
The 3 minutes, but if you'd like to summarize, please do.
So I'd like to summarize. I have actually many other responses, but I think most of the points that have been made in terms of these exemptions is that it seems like people are counting on this exemption not being claimed. And I would argue that that is a terrible model. If you're counting on the fact that someone only has $600 in their account and you're going to be able to get that, and that's part of your business model, I would question kind of the morality of that, I guess. But I would really, really welcome any other questions because, and I can submit supplemental testimony if possible.
Thank you. Thank you so much, Ms. Fika. So since you work with clients who are navigating this, these types of situations that you describe as very onerous and challenging, can you just give us an example of what it is like for trying to, how that actually works in real life?
So how it works in real life is that my clients, the calls I get are someone calls me and says, that last, $700, the only money I had in my account is all of a sudden gone, and I don't know what to do with it. And, I don't know what to do. I can't, the check that I just sent out for my rent or whatever is going to bounce, my electric bill. And so they know that they're going to get hit with fees. And so then I'm trying to walk them through the process, but at the same time, I've had issues. Clients have had problems getting the mail so that they can actually get that claim of exemption form in. Then trying to find out, how to get it in time, finding a notary, making sure that they can go to the hearing if that's necessary. All those things are just things that make it really difficult for the person who is already working a minimum wage job to actually get that money back. And in the meantime, they didn't have the money to buy the groceries, and so these are the clients I have are not people that, that are choosing not to pay their bill because, they're trying to stick it to the credit card company. These are people that have lost their jobs, they got sick, their husband left them with the 3 kids, and they need every penny that they can get. And they're already behind in some of those bills that I would classify as being essentials, like the utilities and the rent.
Thank you. That helps clarify what the implications are. Are there questions from anybody else in the committee for Ms. Fika? Okay, seeing none, thank you so much for your testimony. We really appreciate it.
Thank you so much for the opportunity.
And we are going to move on to Susan Williams. Is Susan Williams with us? Okay, I don't see Susan Williams.
Susan is in the room. Hold on a second.
I'm here.
Oh, you are there. Okay, now I see you.
Technical difficulties.
Of course, we all have them. Anyway, welcome, and please proceed with your testimony.
Thank you. Thank you. Good afternoon, everyone. I actually am a first-time speaker here, and I thought it would be important and potentially beneficial to all to hear things from my perspective. I am an attorney practicing in Connecticut as well as Commonwealth of Massachusetts for the past 30 years, and I specialize in bankruptcy law, representing debtors and consumer law. And I am speaking specifically with reference to bill number 6372 in the automatic exemption. And I do concur with Attorney Fika. In fact, I had intended to really give you some boots on the ground experiences that I have had over the past 30 years in helping my clients navigate this form merely to claim the exemption that is otherwise supposed to be automatic for them, the $1,000 wild card. A lot of things need to fall into place in order for this in order for the debtor to be successful. First of all, they have to get the specific form from the bank. Many times that doesn't happen. If they do receive the form, they have to find their exemption on the form, understand that there's an exemption that needs to be claimed. And the exemptions on the back of the form are itemized A through U alphabetically. And the wildcard exemption that we're speaking of is under R, and it references any interest of the exemptioner in any property not to exceed in value $1,000. My clients many times have no idea what that means. So the exemption is there for them, but they have to know how to claim it. And again, they have to sign the form, check the proper box, have it notarized, get it back to the bank. And many times they can't walk it into the bank. I know specifically Bank of America, in dealing with them, it has to be mailed to corporate. And all of that needs to be done within a certain time frame, within 20 days. And all the while, their money in their bank account is frozen. And again, they have payments set up on automatic pay, necessary living expenses that they're not able to pay, and an additional expense that they incur that they never get back is the marshal fee of $100 and any bank fee associated with that. So they will never get their full $1,000, but even by going through this entire process. And It's not over because now they have to appear in court. If all of that's been done, they have to wait for the hearing. They have to go into court. And the clients that I deal with find this entire process intimidating, confusing, time-consuming, and overwhelming, all to just claim an exemption that the way I read the Connecticut General Statute in section 52(352)B states the following property of any natural person shall be exempt. And we put the debtors through this arduous task. And in my experience, many times clients come in, they make an appointment with me, the time's already passed. They never even knew that they had this opportunity. The money's long gone that they otherwise should automatically be entitled to. I am a bankruptcy attorney, and yes, you can claim that exemption, certainly if you're claiming your state exemptions under the wild card and protect that $1,000, but you shouldn't have to file for, and my clients don't want to file for bankruptcy. That's always the last resort. So this exemption under the state, I feel just sits there and it's not utilized properly because we put our consumers through this arduous task. And I would like to talk about the unintended consequence of the clients going into court. I have had experiences where I've had clients go in and speak to creditors counsel, and creditors counsel has said, well, you keep 500 and we'll keep 500. I don't know what the judge is going to say. And that's real life. And that's happened more than once to some of my debtors. So sometimes the unintended consequences aren't the best for the debtor, and they never get their full $1,000.
Thank you so much, Attorney Williams. I'm sorry to say that the 3 minutes was surpassed, but your testimony was really helpful in clarifying exactly what the logistical hurdles are for people, and not just the form, and I trying to identify what their situation is on the listed exemptions, but also even knowing their rights to the exemption. Most people wouldn't even know that they have that they have the right until maybe it's too late to exercise it. So I know Chairman Doucette just joined us and he wants to say something to you, but I thank you for your testimony.
You're welcome. Thank you for the opportunity.
Thank you, Madam Chair. Hi, Susan, good to see you. Thank you for coming to testify. I think it is helpful, and perhaps you've heard the earlier discussion to describe the fundamental issue as I see it, which is an exemption which is available by law, but does by practice not effectively be utilized. I'm curious that the situation where there was a split, where you said of the 500, how does that get handled, and what does the court say when that situation arises?
Well, I probably should have said that happens outside of the courtroom.
Right,
So
but when that agreement has to be entered in front of the judge.
Yes.
Correct? Or, right.
And in the specific circumstance that I'm referring to, the creditors counsel told the debtor, well, I don't know what the judge is going to say or how this is going to be ruled on. I'll give you 500, we'll keep 500.
Right. So that's a risk that, is being taken, that the judge is not going to ask any questions about it.
But if it's
Right.
only $1,000, they were only in there to claim their $1,000 wild card exemption
Right.
that they could automatically get. So if they just go into the court and say, I claim this, there should be no question
That's it. Right.
represented to the debtor that there's any risk.
Right. Right. No, that's interesting. So I don't see, have you submitted written testimony to us?
I did late yesterday after 5.
Okay. I don't see it. We're still a little behind, I think, with stuff being uploaded, but I just wanted to say your testimony is very helpful. So if you hadn't already, please submit it in writing. And thank you again.
Okay. Thank you all. Take care.
I think we're going to circle back to Mike Simcoe. I see you with us. Just unmute yourself, sir, please. Mr. oh, there.
Test. Is that me?
Yes, now we can hear you. Thank you.
Thank you. It's a pleasure. 500 to me, 500 to you, and we'll see what the judge does. Boy, does that ring a bell. And I'm going to give you the practical of being in court before a judge. Now, first thing, 500 now and 500 for you and 500 for me. You're not before a judge. You are in small claims court, and you are before the best advocate for the consumer you will ever see. And that is a magistrate at the small claims level. And a magistrate, to be a magistrate by statute, is that they cannot know or have ever been to a small claims venue, or if they have cannot had any action before or connection with the small claims venue for at least 2 years before. And magistrates, when you get to a docket with 40 or 50 people, love to hear agreements. So if an attorney comes into his magistrate for item number 35 on the docket, and the attorney says, we have an agreement for 500 now, 500 for us and 500 for the defendant, there is a good probability, not possibility, there's a good probability the magistrate says, so Mr. Defendant, do you know that you have an automatic right to $1,000? That's why if you can get an agreement of 500, you walk out with something. Now, if there is no such agreement and you go before the magistrate will gladly tell the defendant what his rights are, what exemptions he may have, and has he claimed them? Because in my 32 years, and in the group that I'm associated with, the Connecticut Creditors' Rights, I'm on the executive committee, is that you have always had to, and you will continue until the law changes, to check the box. Nothing has ever been automatic. And reading from a practical point of view, that the new statute in 6372 most certainly is $1,000 on top of $1,000. And if it's not specific, I would assure you that a small claims magistrate will say now, if this passes, you know, you have your $1,000 automatic exemption, and you have another $1,000. Has that been explained to you? No, it hasn't. Counsel for the plaintiff, go back out in the hallway and discuss this with the defendant, then come back in. That is how it works. And Attorney Williams was absolutely correct. That's outside. But go before a magistrate. Now, as far as my practice is, I've been practicing 32 years, my father for 55 before that. My current hospital clients are Norwalk, Danbury, New Milford, and Sharon hospitals. Prior to that, I did Bridgeport Hospital in Park City for years. And we always, at my office and in the creditors' offices that I know do collection, that we always presume the person doesn't pay because they mean to. The person pays because they've had something happen that's been detrimental. And they need to have a discussion. And when Attorney Russell London says, call us, we send you a letter, we serve you with papers. How many times do I say to a judge in Superior Court that they've been served in hand, and we hear nothing? That's why for the last 4 years, my law firm, even on small claims matter, goes to the real court. The small claims court is broken. The small claims court by magistrates is run by consumer advocates. Call it whatever you want, but that's what happens at small claims. So we get to this idea now of picking fly poop out of pepper. 1,000, is it extra? Is it on top of it? I'm telling you in practice, it has never, ever been automatic. You check a box. And for
Sir,
that,
your time is actually up. If you want to briefly summarize.
Thank you. I think it's unnecessary what this 6372 represents. I thank you for the opportunity.
Thank you, sir. Thank you, sir. So I'll start with just one comment question. I have been to small claims court many times, so that's why this issue is an interesting one for me, and I have seen this play out. But I do want to press you again because I am curious, as I had the conversation with Attorney London. Where in the statute does it currently say that you have to check a box and that the automatic wild card is not automatic?
There isn't. You know that. I know that, and every attorney has testified. We know that. But on the form,
well, you seem to imply to us that that's just the way it always is. You check the box, check the box.
No, it's not. We don't check the box. And in fact, we don't get the bank execution. The attorney does not get the execution. By statute and by execution form, it is the state marshal or an indifferent person. We as the attorney are accommodation makers that set up a relationship and introduce a marshal to a clerk of the court, and the clerk of the court therefore gives the order to a marshal to go serve. It is out of the attorney's hands. In practice, it isn't. But by statute and rule of law, it is a marshal who gets the execution. It is a marshal who executes. And it is the marshal that the bank will be in touch with, along with the person who is their depositor. We sit back and watch. We can't.
Right, but you initiate, the attorney initiates the process. The
That's
marshal
correct.
doesn't show up on his own.
We make an application. It's not a request. It's not a motion. It's the lowest form of judicial intervention by way of an application with a fee. And we apply for and ask for an order that we can then hand to our state marshal. And the form that the state marshal hands and the form that the bank has a big box that you cannot avoid. It says, I claim, and it gives exemption, and all you do have to check a box.
Right, but you're not, again, contesting the fact that the automatic exemption is in statute and is automatic.
No, I'm telling you in practice, that's how it happens.
Right. And then the second question is, because I am interested, and as I think I referred to it earlier with Attorney London or maybe Attorney Strumpf, that it seems to me to be mental gymnastics to say that this is an additional $1,000 wild card. Explain again why that's your position, that this change to the statute would say that, because I'm genuinely interested if there is any confusion about that we should clear it up.
It doesn't, but I'm telling you in practice, you get before a magistrate who somebody brings that into his head or puts that in his head. That magistrate is much more likely than not, in my experience, to go and advocate that other second additional $1,000. You have no record. My group knows that I go up to the Supreme Court with writs of error, probably more than anybody, because the small claims court, there is no appeal, but there is a chance to go and get a writ of error. And writs of error are typically ordered because small claims screws up. You are correct in your reading, you're correct 100%, but you're wrong in practice. And that's what we see in court. There will be a magistrate, not so much with a judge. In the real court with real rules and real regulations and statutes that can be cited and briefed to, judges stand up. And in fact, you get a decision in Superior Court way before you get one in small claims. Do I pay $235 to go to Superior Court, or $230, or the $95 to small claims? My clients all want me, and have been for the last 4 years, pay the extra $135 and stay away from that broken small claims court with magistrates who have a better calling in life as a consumer advocate.
All right, thank you. Any other questions for Attorney Simcoe today? I don't see any hands. So with that, I will thank you.
Thank you. My pleasure. My honor. Thank you.
Take care. Okay. Gonna go back to our list. I have Houston Putnam Lowry next on my list. Is Houston with us today? Yes, he is.
Yes, I am.
Hi, Houston. You can turn on your camera if you wish.
I think I have, but it doesn't seem to be showing up.
There it is. Now we see you. Good. There you are.
There you go. I'm not sure that's better or for worse. I'm going to comment on two bills. First of all, the first one is hopefully the easier one. Bill number 6369, an act concerning issues relating to mortgages and mechanics liens. One of the first questions that I would raise is the releasing party is supposed to deliver a certified copy of the mortgage release to the borrower. Who's going to certify it? I assume you have it in there because if the first one from the mortgage holder doesn't get there, you want to make sure that they can actually file a certified copy, and the clerk of the town clerk will take it and file it on the land records. It might be easier to say duplicate original, that would seem to make sense to me and would probably address your issue. Second issue is when you talk about filing a bond, I don't have a problem for that. I recognize that the court is slower than it should be. We're not supposed to say anything about the speed at which courts work. But the only thing I would say, and referring once again to my written testimony, is you should have a commercial surety on the bond that you file. So the town clerk's not gonna know, oh, take Houston Lowry because he's financially solvent, or I'm a deadbeat. A judge can make that decision, and the statute says sufficient surety. So I would just say commercial surety, because most commercial sureties are usually solvent. And if they aren't, I'm sure the insurance commissioner is going to have harsh words with them. Doesn't mean you can't have forged bonds, doesn't mean you can't have counterfeit bonds. I understand that. But the last thing you want to do is take a valuable piece of collateral, i.e. the real estate, and substitute for it a surety bond that isn't worth buckets. And now I'm going to talk briefly about the exemptions bill 6372. Once again, I've submitted written testimony. While I am a collections lawyer, to some degree, I'm not generally a consumer collections lawyer. I do have a couple of concerns. One, anytime anything is automatic, there are issues as to whether or not it can be abusive. The statute currently refers to as by account. I also think that there's an interesting commingling funds issue. If you wish to avoid the question of whether or not the $1,000 is additive to the $1,000 wild card exemption, perhaps you should have a statutory cross-reference to make that clear that it's not. Generally speaking, the cases I'm involved with are not going to be paid in full by a bank execution, because I really am involved in larger cases. Currently, I've got one for 140 million, and I have not yet found anyone who has a bank account that has 140 million in it. So, thank you very much. I've just been shown it's time, so I should stop talking and offer to answer questions.
Thank you. Thank you, Attorney Lowry. And let me just say that I do appreciate those suggestions, very practical suggestions, and that's why we are here to hear that sort of testimony. So
it's always been my experience with the committee, and I thank you for encouraging us to participate.
Appreciate that. All right, any questions for Attorney Lowry? Any committee members have any questions? I do not see any currently on the list. So with that, I will thank you, sir.
Thank you, sir. Have a lovely afternoon.
You too. Okay, moving on. Next on our list is Matthew Gunter from RCN Capital, followed by Kathy Flaherty. Is Mr. Gunter here? Yes, he is.
Yes. Hello.
Hello, Mr. Gunter.
Good afternoon. So I'm actually going to be testifying on two different bills. First, I think we'll start with SB 831. That's an act concerning mortgage loan originators. What this is really seeking to do is to correct an oversight from several years ago when subdivision P to section 3176I was added. That was an exemption for mortgage loan originators for the overtime requirements, and a specific limitation on that expansion of the exemption there. This bill, it's changing the subdivisions from the letters to the numbers. So now that old existing subdivision is number 16, and we're seeking to add number 17. Or that's what we're speaking in favor of, is to add the exemption for commercial mortgage loan originators. RCN Capital, we have 25 loan originators that work for us. We call them loan officers. They are the ones who are doing the same exact work as any other loan originator from the residential on consumer side of the banks or the credit unions. So what we wanted to do is make sure that the commercial mortgage loan originators, our loan officers, are getting the same overtime exemption that the consumer side is getting. And that really, the benefit to that is they want to be able to work more than 40 hours. They want to be able to answer their phone calls, to talk to their clients, to their brokers, after 5 o'clock. They don't want to be limited to 40 hours. They want to do more business. They want to bring more lending into Connecticut. So, we do a lot of lending across the country, so that the more loans we do in Connecticut for money that is being applied outside of Connecticut is now income coming into Connecticut that would otherwise be lost. The other bill I want to speak about is an act concerning issues related to mortgages and mechanics liens, 6369. There's 2 issues identified in section 1, and that is the first where it's requiring the mortgagee to deliver to the town clerk the release of mortgage. The issue with that is that it seems like it's a mandate to deliver the release directly to the clerk, as opposed to upon request to the mortgagor or to a title company who's conducting the closing. Oftentimes we'll find that somebody's requesting this to be held in escrow pending the payoff, and we oblige those requests. We want to give it to them so that they can record it themselves. But this is now suggesting that we have to deliver it to the clerk ourselves, and we can't go with their requests. We have to just record it after the fact. We can't allow them to hold this in escrow. The other concern is with providing the certified copy of the release. Again, this is going to be an extra expense. It doesn't, the bill doesn't identify when this has to be done. It doesn't identify whether it's upon request, which it should be, if anything at all. It should be only upon the written request of the borrower or the mortgagor's attorney. And frankly, if they're going to be getting a certified copy, they could as easily get that from the clerk themselves rather than the mortgagee getting that. So I see my time is up, but I welcome any questions about that.
Jason, your sound is not showing up, even though you say you're. Hang on one second.
Oh. Okay, well, I'll take over.
Yes, please.
Okay. All right, well, thank you so much for your testimony. Are there any questions? Okay, seeing no questions, we will move on to our next person signed up, who I believe is Kathy Flaherty. Oh, sorry, Representative Delnicki, do you have a question?
Representative Delnicki, unmute, please.
Thank you. I just had to make an observation about RCN. They are a local Southampton business. They've got an excellent reputation. And they are providing, and Matthew, how many jobs are you providing there?
In the state of Connecticut, I think it's right now 90.
Okay, and growing, I understand.
Yes, hiring, it seems weekly.
So I just wanted to make those comments. I've actually seen your operation over there and had toured the building, and I give you high marks.
Thank you very much, Representative.
Thank you, Madam Chair. And I have to apologize, this Zoom, sometimes it can be daunting.
We're all in the same boat with this technology. It's an adjustment. Any other questions for Mr. Gunter or comments? Okay, seeing none, thank you so much, Mr. Gunter, for your testimony. We really appreciate it. And welcome, Ms. Flaherty. Did I say that correctly?
You did, Senator Castor.
Oh.
Thank you. Chairs Castor and Doucette, ranking members Delnicki and Berthel. My name is Kathy Flaherty. I'm the Executive Director of Connecticut Legal Rights Project, and we provide representation in civil legal matters to people who are eligible for mental health services from the Department of Mental Health and Addiction Services. One area of law in which we do not represent clients is consumer law. So you may be wondering why I am here, but I am here because I have 15 years of working at Statewide Legal Services of Connecticut, where I spent a lot of time advising consumers who were dealing with the problems of debt collection. And I can assure you, both from that perspective and personal perspective, is that when people have these debts hanging over their head, they are not ignoring them. Believe me, they are weights that weigh on people and impact their mental health. And the system for a layperson is difficult to navigate. My colleague, Michelle Fica, gave you a great graphic, and it actually brought back bad memories for me of having to explain that to people on the phone of what they needed to do and when they needed to do it. But if we can automate that protection for that first $1,000, we should put the burden of the system on the part of the system that is able to bear the burden of it, which means not people who won't be able to put food on their table or pay their rent or pay their utilities. And put it on the banks and frankly, the creditor bar. I appreciate the work that they do, but in terms of people who have to navigate the system, to the extent that we can make things easier for them, I think we should, and I appreciate the committee raising the bill. Thank you.
Thank you so much, Ms. Flaherty. And I have to agree with you. If our law is that someone has an automatic right to something, they should not have to jump hoops in order to exercise that right. It should actually be automatic. So thank you for your testimony and for the work that you do helping people in difficult situations. Are there any questions from committee members? Okay. Well, thank you again so much for your testimony.
Appreciate it. Have a good day.
Are we? Okay, great. And we are going to move on to, so I'm just consulting my list, Heather Wallace. Is Heather Wallace with us? Okay, I don't see Heather right now. Oh, I do see Heather, but she needs to, yes, now we can.
Yeah,
There we go.
there we go.
Yeah, great, perfect. Okay, welcome.
Now I can't get situated right. Sorry about this. Difficulties with my camera. Good afternoon, honored distinguished members of the Banking Committee. At this time, I wish to thank the committee for allowing me to offer my testimony regarding House Bill 6372. Again, my name is Heather Wallace from New Fairfield, Connecticut, and I've been licensed to practice law in Connecticut for over 20 years. I have practiced law in both Superior Court and Small Claims Court. I'm also the only attorney in Connecticut for my out-of-state firm, which means that I deal a lot with consumers. And especially in this day and age, it is very vital that we come to a compromising position when we start talking with the consumers about payments. And I'm always willing to compromise. What I have a problem with is with the bill is that I see that this is taking away that ability to compromise, because as prior counsel just declared, most people do want to pay their bills. They just, something happens and they're unable to. Sometimes just filing an execution gets them to wake up. They file their claim and we, again, talk about a compromise. With respect to the form for the claim, the form is something that we apply for. That is not something that we prepare. The form is then approved, the application is approved by the clerk, and we send it to our marshal to serve upon the banks. The banks are then obligated to provide these forms to the consumer. And they have the obligation, they can look at it. The directions are right there in bold print, section 3, notice to judgment debtor. And then in all caps, again, bold print, how to claim an exemption, established by law. Then section 4 sets forth the affidavit, which means if it's an affidavit, it needs to be a sworn statement. So unfortunately, it's, they have to go and get it notarized. But this provides the court with a sworn statement that these funds are protected. And I know it's maybe, some people are finding it difficult, but it's really not a difficult form. And it's not something that we as creditors, attorneys prepare. It's a form that is, like I said, bold letters, all caps, and it provides right there an amount in the bank not to exceed $1,000. All they have to do is check the box. Then it goes to court, and most of the times we'll just release it if we see that it's under $1,000, because it is an automatic. If we see that it's claimed, we don't know yet until we see these claim forms. So we as attorneys can't know that there was under $1,000 in that bank account until they tell us. So we have to find that out from the consumer. And like I said, they just have to take one step. They're provided these forms from their bank, not us. And then they file the claim for exemption. And again, most of the time, as in my practice, if I see it's under $1,000, we'll release it. We'll tell the marshal to just go ahead and release it. No need to go to court. But then again, it prompts the consumer to give us a call, and we'll talk.
Thank
and
you.
I get
Sorry,
into
that's your time.
That's what I thought. So I will answer any questions if you have any. And if not, have a wonderful day. Enjoy the snow. And hope everyone stays safe.
Thank you so much, Attorney Wallace. Are there any questions? Okay, seeing none, thank you so much for your testimony, and we will move on to Lisa Davis. Welcome, Lisa.
Thank you, everyone.
Thank you.
Good afternoon, Senator Kasser, Representative Doucette, and members of the committee. Thank you for giving me the opportunity to speak. I'm not sure, can you see me? I can see me, but I'm seeing Dawn.
We can see you.
Okay, fine, I'll go on. I'm Lisa Davis. I'm submitting this testimony on behalf of the Connecticut chapter of the National Academy of Elder Law Attorneys and the Elder Law section of the Bar Association in support of Bill 6373, an act preserving the interests of prior title holders. This bill has been before this committee possibly 3 times previously, and in fact was voted out, but it hasn't made it across the finish line before. We think the current version is improved and addresses some issues that perhaps weren't addressed before. The purpose of the bill is to protect the interests of lenders to the many Connecticut citizens who own homes, but who also receive public benefits such as Medicaid. And by protecting the lenders' interests, it ensures that seniors and the disabled will be able to have access to reverse mortgages, home equity loans, and private loans that will help them stay in the community and avoid institutionalization. It also has made some corrections to our lien statute to ensure that DSS, the Department of Social Services, will not be violating federal law. It should not cost the state anything, and it includes additional provisions this year to make it very clear that it does not affect or jeopardize any of the state's other collection efforts that are legal and are permitted. So it has 2 sections. Section 1 makes clear there's no illegal super lien for Medicaid liens, and also provides for due process before a lien can be recorded, or excuse me, not before a lien can be recorded, but due process at the time of the lien. Federal law makes clear that there are very limited situations in which liens are permitted in the Medicaid program at all, and that there is a need for due process. And I would just direct the members to 42 USC 1396P. And I sort of hoped that this bill would contain a reference to that and to those exceptions, but at any rate, there are very limited situations where liens are even permitted at all. And then section 2 corrects a problem that arose because there's a very old Connecticut law that seems to require the recipients of public assistance benefits, whatever they may be, to get consent from the commissioner of DSS before conveying any property. It doesn't even accept sales, actually, even when there would be no basis for the commissioner to deny the consent. And there's another bill, I think Senator Kelly has a bill to try to eliminate this old law. And frankly, that would be just dandy. And but our bill was a little more limited, clarifying that the failure to get the consent of a commissioner should not invalidate an otherwise perfectly valid conveyance, that cannot be used as a basis to invalidate it. At the same time, this doesn't affect any of the other remedies that are available to the Department of Social Services when a transfer of assets is made during the 5-year look back, if anybody's heard of that. It doesn't affect any of the legal remedies that are out there. And so the point of this, these are very technical things, but the point is to make it clear that people who, even though they may be receiving certain benefits, they should still be able to borrow money and give a mortgage and thereby to stay at home. I realize I don't have time for this, but I have a story to tell if you would ask me to tell it about a case. Thank you very much.
Thank you. Have you submitted written testimony?
Yes, I have.
Oh, good, great. And does it have a reference to the federal statute that you cited?
It has the federal statute, yes.
Okay. Would you like to tell your story?
Okay.
If you could
It'll be brief. It'll be brief. I had a client who had a mother living at home with some dementia, and he wanted to be able to keep her at home. And it's not that easy. Then there are many costs associated with going out and getting a commercial mortgage. And in any event, it was a private loan that he made to pay for her caregiver. And in fact, he happened to be a lawyer. So she signed a note and she gave a mortgage on the house to secure repayment of the loan that he was making. And in fact, she was kept at home for several years and he paid out an awful lot of money. And then subsequently, so there's no lien on the house in that situation. Later on, she had to go into a nursing home because she just couldn't stay at home anymore. It was 2, 3, 4 years later. At that point, the federal law allows the state to record a lien. They're actually supposed to give prior notice. In this case, the house was on the market for sale. It was basically underwater because of this loan that the son had made to her. And on the eve of the closing, possibly the day of the closing, suddenly the last minute title search disclosed the lien. There hadn't even been any notice for it. And even though this mortgage and the payments had been made far before this loan was recorded, the state absolutely refused to release the lien until its claim, which at that point was for quite a bit of prior benefit, was paid in full. And in that position, you're on the eve of the closing. The title company doesn't know, is not going to insure over that, or you can't have a quiet title. You're stuck with it. And he lost $60,000 because of this situation. This was a while ago, and I've been checking with my colleagues to see if these sorts of things are still happening, if that was just a one-off. And according to my other elder law colleagues, this does happen. It usually only happens when there isn't enough equity to pay both, so it doesn't always come up. But they've had experiences like this. So that's my story.
Thank you so much. Chairman Doucette.
Thank you, Madam Chairman. Yes, I was going to ask the same thing, but I also had a follow-up, which you kind of touched on there. I guess we've discussed this for several years now, even before I was around, but maybe you were involved in some of the discussions prior to that. But the Department of Social Services has concerns with this, and we've had some discussions where I think although we've described such cases like the one you've just told us about to them, I guess they still are having trouble understanding where the problem lies. So my question to you would be, and again, you sort of answered it, how could we improve the process short of what's in this bill, either if this bill is not enacted, or if it is, how would we improve the process so that DSS's concerns in that any valid recoupable claims that they may have would still be recoverable?
Well, two things. One is they're talking out of two sides of their mouth, because if this never happens, then it won't make any difference, because they're already doing what we've said they should do, number one. And number two, we did address this. We have addressed this in two ways. One of them is to include a notwithstanding that there's nothing in this bill that shall affect the state's rights under. We've changed the statute. We've moved this to the liens statute, the 17B-79, and it expressly says that the state's rights under 17B-93 and 95 shall not be affected, because I don't know where they're coming from, but I suppose they were extrapolating. They were trying to think of some scenario. There's an old case where someone tries to disclaim real estate, and maybe they thought that somehow that was going to affect that. I have no idea where they were coming from with that. We're just talking about, liens, real estate closings, and they're saying that that never happened. So we did that, and then we scratched our heads and thought, well, what else might they be thinking of? And since they generally seem to think that all elder law attorneys are, devious connivers trying to steal the public's money, we thought, they think we're going to cloud the title. Everyone's going to run around and record these fake loans that really there's no consideration. Every now and then you might run into one of these people who does a conveyance tax return and reports it's a sale instead of a gift or something like that. Every now and then, I mean, there's going to be some bad apple somewhere, I suppose, but we included by saying that if they can prove that this was just purely for purposes of clouding title, then this, what we put in, wouldn't apply. Now, I have to say, when I liked better having language in there saying that there would be a cause of action against somebody who actually did that to cloud title. I'm not a litigator, so there may already be such a cause of action. I don't know, but it did make it clear that in some situation like that, where it was clearly a gift disguised as a mortgage, then that wouldn't apply. But that would really put the burden on them to do that. So in our case, for example, we had already submitted what we thought was documentation of all these expenditures that had been made as the consideration for the mortgage. And there's a degree of proof that can be accepted by the state. So this had been done over years, and so at the 11th hour, at the closing, people didn't have every single receipt or something like that, but there really wasn't any dispute that money had been paid by the lender. You could argue about, did he pay it just out of the goodness of his heart versus as a pursuant to a note or something like that. But I mean, it really wasn't that type of a situation. So, and the mortgages are necessary because many times the problem that we really have is we have generous family members try to help the people at home, and they generally don't think about a mortgage, and they end up, the lien goes on and they didn't even have a chance. This is for the people who at least were sort of thinking about, I can't afford to give this money to mom, but as long as I get paid back when her house is sold, at least then I'll have my retirement will not be wiped out by having made this loan to my mother. And one other point, this is not just the private lenders, and you'll see that the Bankers Association is supporting this as well, because many of our attorneys also might do real estate closings and write title policies. And if they're going to write a title policy for a reverse mortgage company, let's say, and they know about these claims that the state has and the possibility that the state, it's hard to think the state's really going to go to tangle with Wells Fargo or something, but conceivably you as a legal matter, CADIC isn't saying that you can insure over something where that there might be some sort of a super lien. I mean, you'd have to does a reverse mortgage lender have to inquire? Particularly, there's thousands of seniors who have these Medicare savings program benefits that pay the copays and deductibles of Medicare. They're low to moderate income. They're not, they're not wealthy, but they're not people who are legal services customers necessarily. And so there are many, many people who have those benefits. And without this provision in the law, arguably, the state has a point. Maybe they're right. And those people, their mortgages are no good because they couldn't contact DSS. And there's no mechanism to do it. DSS doesn't want to be contacted and ask for permission every time somebody gets a mortgage.
Mhm.
They really don't. When we've tried to, they don't want to respond. So.
So as a practical matter, though, there's nothing in this legislation that would take away the state's right to assert that lien. It's just a matter of priority, right? So my question is, as a practical matter, DSS could simply timely file any lien rights that it's trying to assert, correct?
Correct.
And that would then provide notice and would then presumably provide.
Well, this version of the statute also requires them to not just record it, but in the statute as well as in the federal law, which not everybody who's an elder law attorney would know that they're supposed to do this. It makes it clear in the statute that they have to notify the landowner that there's this lien. And again, at 1396P, quite often there are situations where the lien is not allowed to be recorded. For instance, if there is a disabled child, they could be on Social Security disability after years of work and not a poor person, but the law says if you're a disabled child living in the home, no lien may be recorded. Right. And nobody would know that, but at least hopefully if somebody gets a notice that there's a lien on their property, they're going to go and find out what their rights are. And normally the state may not even know that. Actually, the state could record the lien because nobody told them. So they have to send a notice, and that's a whole other conversation about the terrible notice sending that DSS sometimes has. But at least that makes it clear. It underscores the fact that they have to give notice.
Right. Yep. Well put. Representative Delnicki.
Thank you, Mr. Chair. Just a couple of quick comments, and maybe Lisa, you can validate this. We've heard that the primary victims of DSS not placing a lien on in a timely fashion are typically a child or a spouse of the individual that they're trying to help.
So you mean in my examples of who gets hurt is the private lender versus the bank lender?
The private lender, typically a spouse, a child, that they are the ones that are typically getting victimized by DSS not putting a lien on in a timely fashion.
That's my understanding, but there again, as I've said, the other problem, and this puts lawyers like us in a dilemma, which is, I mean, the state clearly can't make an argument that says, well, we will only do this to private lenders. It has to be based on their legal theory, which is the statute. And if I mean, I don't actually do this, but if I was issuing a title policy on something, I mean, where does this put you? Because they have asserted that it's their legal theory is that the conveyance is no good because the person didn't ask permission. So, you know, I would think that I would have to go and say to my client, if I was doing this, you know, you may need to screen your borrower to find out if they're on any public benefits.
The other thing that we hear, or we've heard a number of times from DSS, is the fact that they're afraid of a substantial amount of money that they're going to lose on this. And I'm just asking for your learned opinion of what the impact of them and their failure to file liens in an appropriate fashion, how that actually has hurt people, and that if they did file them appropriately, how it would help them.
So with respect to them, I don't understand why they say they're going to lose money, because really all we're saying we're doing is clarifying what they're already saying is the case. I mean, first they're denying this, and secondly, federal law requires the notice. So we're not, in that case, we're not changing anything. And we're not saying you can't file the lien. Nobody's saying they can't file a lien. We're simply talking about the priority of who's entitled, who gets first, and it's first in time, first in right. You go to the land records, is there a lien? No, there's no lien. Okay, now I record my mortgage. I have priority over the next guy. I mean, that's the basic way it is. So it seems to me if that's what they have said in their prior testimony is that they understand that to be true as well, then the only time they're losing money is if they were doing something they weren't entitled to do. You know? So that
if they
doesn't
act-
make sense. So I don't think they shouldn't lose any money from this. They shouldn't lose any money unless they were doing something unlawful.
or failing to exercise their rights in a timely fashion.
Or being late is your point. So yes, but I mean, the point is when you the mortgage has to be for consideration. So if perhaps they're saying that the minute mom goes into the nursing home, somebody rushes off at that moment to record the mortgage. I don't see how you would do that, because that would be for past consideration. I mean, what would you be doing the mortgage for at that point? It's when these things happen, when the help is being provided early in the process, not late in the process. Now, one situation that they may be thinking of is mom is at home and is getting benefits under the Connecticut Home Care Program, which is a wonderful program. And when you die, the state wants to get paid back and wants to make a claim against your estate. And also when you go into a nursing home, then they want to get paid back at that point in time. And the fact that they can get paid back, certainly is a disincentive for people to access that program, which is not good, considering that we're trying to keep people at home. But frequently, again, you'll have people where the state is great, but there's not enough. So the family, or a bank has to, and I have people who do both, reverse mortgages with commercial entities. It's harder to do that now, or private. And at that point, maybe they're thinking that people will just help for free, not put a mortgage on the property. And so later on, when my client goes to the nursing home and they put the lien on, then they'll get the house. But I would just say then they're getting it is unjust, because this financial help has been provided to keep someone in the community, which they acknowledge. The Medicaid will not pay for 24/7 care at home. I spend a lot of my time trying to figure out how to work it so someone will get to stay home. So it could be they're thinking of those people on the home care program. But again, then I would say it's not just.
I thank you for your testimony. It's pretty obvious, in my opinion, something has to be done here to right a wrong. Thank you. Thank you, Mr. Chair.
Thank you, Representative. Anyone else with any questions for Lisa? Attorney Davis. Almost everyone is an attorney who's testified before us today, so should just got used to saying that. If not, well, thank you for your time and your testimony today. It has been helpful, and we appreciate it. Thank you. All right, next on my list is Melissa Linden. Is Melissa here? I did not see Melissa yet.
Melissa withdrew.
Okay. So then we'll go to Sonia Gibson, who I believe is with us today. Hi, Sonia. Welcome.
Hi there. Can you hear me okay?
Yes.
Great. Okay. Hello, chairs, ranking members, and vice chairs, and as well as committee members. My name is Sonia Gibson. I'm here on behalf of Encore Capital Group, speaking in opposition to House Bill 6372. I've also already submitted written testimony, and I realize this bill has been discussed at length, so I appreciate this opportunity to add in a few more points. Encore, by way of background, it's a secondary creditor, and bank levies in general are a last resort for many creditors, including Encore. They're the last option after sometimes years attempting to work with consumers through payment plan offers outside of the litigation process. And really, bank levies are used after a court-ordered payment plan in Connecticut has been violated by the consumer. We completely, wholeheartedly agree to helping consumers in need and those that are having hardships, such as through the COVID pandemic. And many of our policies cover this in this regard. But while well-intentioned, this bill is proposing to exempt 2 months of wages in all debtors' bank accounts, no questions asked, automatically, rather than focusing on those consumers that actually need help. Its blanket approach to exempt all from repayment on judgments is not something that should be supported. There isn't a creditor who's spoken today who would be opposed to adjusting or easing the process for a claim of exemption, which I understand seems to be the described problem. but because it's not in our interest or our consumers' interest to bank levy someone in hardship. But this bill is proposing an automatic across the board, anyone and everyone exemption, and 2 months worth of wages at that. And this is the process that's at the very end of the line. The legislation as described would reverse a Supreme Court's ruling in the Cato case that debtors cannot shield post-garnishment wages from further execution in their bank accounts. And as described, there are a hefty list of federal and Connecticut law exemptions that provide protections for consumers. If the discussion should be shifted to talking about changing the claim of exemption process, if that's the problem. But further expanding exemptions to an automatic high dollar value, such as 2 months of wages, makes it extremely difficult for creditors to recover monies that are due on valid court judgments. Under this bill, creditors are going to be simply unable to recover on outstanding debts in this very last resort option of a bank levy, and that would be absolutely detrimental impact to the availability of credit for Connecticut consumers everywhere, especially the low income, low credit score consumers that I think we're attempting to help here. So for those reasons, I ask you to not support this proposal, and thank you for your time.
Thank you for your testimony, and thank you for sticking in there. I appreciate it's hard to go towards the end, but we appreciate you doing so. And thank you for highlighting the issue of the wages, which is, I think, something we do need to look at the language in a little closer in that respect. Any questions for Sonia from committee members? Anyone? Okay, seeing none, again, thank you for your testimony this afternoon. Take care. Okay, next up, I believe we have Diana Pfeiffer. Is Diana Pfeiffer with us?
I am. Hello.
Oh, there you are, Diane. Thank you. Yes, I can.
Hi. Thank you for the opportunity to testify today for HB number 5427. First of all, I'm the Vice President of Sikorsky Credit Union. My department is Loan Servicing and Collections, for those of you that don't know me. To provide a very brief background on Sikorsky Credit Union, we're a member-owned, not-for-profit financial cooperative regulated by the Department of Banking in Connecticut. Today, we are a credit union with 50,000 members and 700 million in assets. Our management structure is a volunteer board of directors and a supervisory committee. At Sikorsky, we are committed to act in the best interest of our membership. That is our stated mission, and it drives absolutely everything that we do. To fulfill our mission, we're always balancing the rights of the individual member and our overall membership field. When we have a defaulted loan, we do everything we can to establish contact and work with a member toward a resolution and to resolve the issues that they're having. However, there are some instances where these efforts fail and we are just forced to litigate. It's sad but true. I provide this background because, like this committee, I understand striking an equitable balance in difficult situations. I believe that the proposed changes of this bill, though, would upset that balance and lead to many unintended consequences. For example, the cost of the application fee for bank loans have increased 300% since July of 2009. So this increase leads us to be very selective with this use of a post-judgment remedy, which is really our last resort. Using my sample in my written testimony from July 2018 to December 2019, 66% of accounts did not recover funds because of the operation of existing exemption laws. Of the accounts that were recovered, 62.5% filed for exemptions. So I believe that these figures demonstrate the effect and the success of the current framework already legislated and in place. Additionally, I wanted to bring up the operational risk that has been brought up before. The proposed bill puts an undue operational burden and significant risk on credit union as it relates to the direct deposit wages in the look back phase. You can see in my written testimony, we are not privy to this information, unlike the judgment debtor's employer. And yet the credit unions will have a statutory obligation imposed. We simply don't have the information necessary to comply. I also believe that Connecticut businesses will feel the impact either directly or indirectly. So I urge the committee to vote against this. And I thank you for your time.
Thank you, Ms. Pfeiffer, and do appreciate those real world experiences and the data that you have provided from your organization. That is helpful to us. Any committee members have a question for Ms. Pfeiffer? Anyone? I do not see any hands raised at this time. So I will thank you again for your patience in appearing before us today. Thank you.
Thank you. Bye-bye.
Okay. Next, and I think last on our list today is Attorney Sarah Porras, who is with us. There's Sarah. Hi, Sarah.
Good afternoon. Hi.
Welcome.
Thank you. Thank you for the opportunity to testify today. I'm sorry I registered late, but I've been listening all morning and afternoon, and I did submit testimony this morning. I emailed it to all of the committee members as well as the other email. I don't know if anyone, I've testified before, I'm in support of 6372 to make the $1,000 exemption automatic with bank executions. I could address some of the questions that came up in response to Attorney Williams' testimony. For example, what happens in small claims court, right? I think we're trying to strike the balance here between creditors not being able to collect on judgments that they have and not, denying your average hardworking person the ability to pay their rent, to buy medicine, to buy food, to pay the electric bill, and things like that. And the balance is hard to strike. And a lot of the testimony is very anecdotal. And I think that makes it hard as well because it pulls on emotions more than anything else. One thing that does happen when the example, for example, of the situation where someone comes into small claims court and asks for their $1,000 exemption and so what happens is everybody goes into small claims court and the magistrate calls all the cases to see who's there and then says, okay, if you have a match, meaning if there's a plaintiff attorney and a defendant in the room, go out in the hallway and talk. And what happens is the attorneys for the creditors will have a line like 10, 15 people deep behind them. You wait your turn to talk to the attorney for the creditor, and it's done very quickly. Oh, you're here to get your $1,000 exemption. Well, we don't know what that. So here's where it's uneven. The lawyer's there every week. The lawyer knows how the system works. The lawyer knows that the consumer they're asking for their exemption is afraid of this judge, doesn't know that the judge will give it to them automatically, thinks it's an argument, thinks that they have to plead their case, and if they don't do a good job that they won't get it. So that attorney knows how the system works. That attorney as well gets paid every time they collect money. That's generally how collection works, is that creditors' attorneys have to wait to get paid. They take a cut and they pass the rest on to the creditor. So if you're an attorney there with 15 cases and there's 15 $1,000 exemptions, it doesn't always work that way. And you can get $500 out of everybody because they don't know, you could do that 50-50 split. Then you're collecting generally, I think it's 20% of that $7,500 that you've just managed to convince all of those consumers to cede to you. So they're coming home with a payday. They're not coming home empty-handed. So there's this uneven balance where the lawyer knows how it works. The lawyer knows they just need to convince the consumer to be afraid of what's going to happen when they go back into the courtroom. And that's what happens is they go in and they say, we have an agreement. And then the magistrate doesn't get in the way of that agreement. They could, and maybe they sometimes do, canvass that consumer and say, do you know that I was going to give it to you the full 1,000? Would you change your mind? They also don't want the lawyer to get mad at them. They don't want to be subject to future executions, that they think might be retaliatory. They don't know when it's happening. They don't know when it's coming. So that's the dynamic that occurs. And on top of all the mechanical things that have to occur to get in front of that magistrate, to get into court, first you have to actually get the paperwork from your bank. I don't know how many times, again, anecdotal, I've gotten calls from someone and I say, the reason why there's no money in your bank account is you have a bank execution. Did you know that? No. You didn't get a big thick envelope of paper from your bank? No. Have you moved recently? Yeah, I moved 2 months ago. That happens all the time. And sometimes the bank doesn't get the paperwork out. Sometimes the post office doesn't deliver the paperwork. So there's a lot of issues, and the creditors are in a much better position to figure out how to get consumers to pay. And the bottom line for the creditors is, yes, it will be effective, but that $35 or that $100 or that $500 that they get through the execution means so much more to the person being executed on in general.
Thank you. Thank you. And again, we appreciate the real world implications of these things. That's why we have these hearings. And so yours are very helpful. And I was going to ask, but I think you sort of covered it. How often do you think debtors actually even understand that there are any exemptions or that there is any ability to apply for these exemptions?
I think that the people who work in the legal aid organizations probably have a better idea. They see these things with much more regularity than I have, though I have been doing this work for about 15 years. The problem, although Attorney Wallace stressed how easy and clear the form is, I mean, you do have, again, the fact that it's possible the consumer didn't receive the information from their bank. When they did get it, it's confusing. There is a wide array of literacy among Connecticut's population. Sometimes they check off the wrong box. So I talk to people and I look at what they did file, and they've checked off like all these strange exemptions because they think that's what's relevant. And it was that they didn't check off the $1,000 exemption on the form when that's 100%. And they didn't even have a full $1,000 or more in their account. So it's a misunderstanding. If they try really hard to get it right, then the instructions are send it back to your bank. And then again, the time frame, all within 20 days, or else that money goes away. So the system right now is really, really difficult to comply with. And just to be clear, currently under COVID, the magistrates, at least in the Hartford Judicial District, according to one Superior Court judge I just spoke with, he basically said, we've discharged our magistrates and Superior Court judges are handling everything. How that's going to change the quality or the way things work is beyond me. And now who knows how much longer we'll have things by video. That's another accessibility issue. On the one hand, it might be easier to go into a place at work where you have privacy and attend a virtual hearing and not have to drive to the court. But on the other, that might make it even harder for some or other people to access their hearing on exemptions.
Right. A big issue, many implications. Okay. Any other committee members have questions for Attorney Porras? I do not see any at the moment. So with that, I will thank you for your testimony.
Thank you again.
Good to see you. Okay. I'm going to ask our clerk if she has been notified there's anyone else, any other signups on our list.
No, that ends our list.
That is the end of our list. Okay. So with that, without objection from anyone else on the committee, I will close this public hearing of the Banking Committee, and thank you all for your attendance today. And we look forward to seeing you again soon. Thank you, everyone.
Thanks, everybody.
Thank you.
Thank you, John.